All right, yo, what is up for everyone watching this on the YouTube replay? I hope you're having a good Sunday. I'll start this off with a really quick stock portfolio update, and then I got a list of stocks that I think are pretty attractive to potentially look at buying this week. Of course, none of this is financial advice, but yeah, let's start off by going over my Webull portfolio here. This is just like my risk on account. So all time, we're up 26% all time, or $4,000. A lot of that's been led by AMD, Dave, Clear Secure, Robinhood even. Actually, my biggest regret is like selling and trimming some of these positions like Robinhood. I used to own like 50 more shares. Oh, watch out for that person in chat there. I think I can. Okay, cool. Okay, yeah, here are my big losers. So I love being fully transparent. I go to a bunch of other streams. No one shows like their most recent purchases, their total lifetime portfolio performance, how much they're up and down on every stock. And so I try to be fully transparent on here. Of course, I sell nothing just on here giving my opinion. That's not financial advice. Here's my Robinhood portfolio. This is known as my dividend only account, where of course you can probably guess every stock in here does pay a dividend. But as you can see, most of these are like dividend growth companies where the yield isn't too high right now, like Google, Meta, Constellation Energy. We know they only have like yields like 0.4%, like under half a percent, but I'm really buying them for the stock price appreciation and the future dividend in a long time from now. Like, who cares if they have a small yield when Google is giving me 121% total return? McDonald's we're only up 0.9% on. United Rentals is up 72%. United Rentals, this is the company that's benefiting from all of the construction coming back to the US. With all these tariffs, we're starting to manufacture a lot more in America, so a lot of construction is happening and data centers are being constructed. Like Caterpillar and United Rentals have been two big beneficiaries of that. So I'm a very happy United Rentals shareholder. I also have Carlisle. This is one of the stocks I think are a pretty attractive stock to maybe look into buying as interest rates go lower. Right now, the market's pricing in an interest rate hike, but we just had, there's some potential news on that we'll cover in a minute. And then Constellation Energy, this is one of my for sure favorite stocks to buy in the market right now, not financial advice. This is the company that's powering nuclear or powering data centers with their nuclear reactors. This company is the purest nuclear play. There is no close second. They own 33% of all the US's active nuclear reactors. So it's the purest nuclear play. They're also the number one geothermal energy play and the number one or number two natural gas company. So our personal natural gas bill is through Constellation Energy. That's how I found out about the company. So yeah, they're on a big trend. I used to be up a bit more, but yeah, just year to date since January 1st, they're down 28%. So they're starting to finally come back to a price where I can start to buy more shares of. And then we also have Meta Platforms. This one's been struggling kind of with all the Mag 7 recently. Yeah, down 15 or 14% year to date. Luckily, we're still barely up. We're up 7.6% on Meta, not too shabby. So yeah, that's our dividend only portfolio. Year to date, we are just barely down 0.26%. The past year, we're up 15%. We also have a Roth IRA. We started this pretty much exactly a year ago, and we're so close to break even. We're still down 0.8% since we've started this, but here are all the stocks that we own in here. We only have four. I try to keep it simple. In this portfolio, I only have, six companies. Over here, I only have four companies, and these are the four stocks that we own in here. So, yeah. Can you tell us your mistakes? Well, actually, yeah, some of my biggest mistakes have actually been selling out of great high quality companies. Can you believe I sold all my Palantir shares at $11 a share? Now it's like 100 something. I'd be up over 10x. Robinhood's another one. If you look right here, I had 50 shares. I sold all my Robinhood shares at 36 a share, and it's 93 today. So sometimes like your biggest regrets will actually be selling out of high quality companies. Even like they say you can't go broke taking profit, you take a 50% gain. Here's actually my biggest loss ever, and actually thank goodness I sold it all for a loss. But here's where I sold my shares. All right, I sold my shares after this massive downtrend. Here's where I bought it. You ready? Look, there's one buy order here. Let's keep going. I bought it like way higher. Yeah, I was buying this stock again. This is what taught me how to buy high quality companies. So here I bought it at like $300 a share. Then if I zoom out a little bit, I sold all my shares way down here, and thank goodness I did because it's only gone lower since. Here's how you know, here are the type of companies you never want to buy. And this was years ago. Companies that just lose an insane amount of money. I just don't want to buy companies that lose net income. Just think about this. This is how I now approach stocks. If you look in the top right, the market cap, that's how much the whole company's worth. This whole company right now is worth 184 million. You could buy the whole company for 184 million, but think about this. Do you want to buy a company for 184 million that as soon as you buy it, in just the first 3 months, they lose 43 million, then 44, then 50, then 60. No wonder this stock has done so bad because it's going bankrupt. And I used to never look at financials. Now I do because it really does move the stock lower. Like the market's at a close to all-time high right now. This one's at an all-time low because of the poor fundamentals. There's a million more examples like Lucid and a bunch of these other ones. So yeah, I really try and focus on high-quality companies. And that leads me to my last portfolio here where I've finally done this. I've made a portfolio called my buy and never sell account, where if you look in the top left, I call it buy and never sell because once I buy a stock in here, I'm literally never allowed to sell it. It's an experiment I've done for just over 2 years now, and I can't believe it. We put 17 grand into this portfolio, and it's up $33,000. So our whole account is now worth $51,000. I've been tempted, like Powell Industries right here. We're up 1,000% on this company, but I'm telling you, I've not trimmed or sold a single share ever. Same with Comfort Systems. We're up 415%, and that's honestly the reason I believe we've done so good because I haven't trimmed or sold before today. Like most people, when they're up 100, 200% on a stock, will, at least trim or sell a little bit, but not me in this portfolio. It's specifically my experiment where I'm never allowed to sell a stock in there. So what's up, everyone? Good to see you. Sorry, I'm a little behind on the chat. Good to see you, Riaz, Tom, Mike, Japan. Hope everyone's having a great Sunday. What's up, Shazunk? I sold a lot of my SanDisk and I regret it. Yeah, the memory stocks have been going up like crazy. So here's actually a little list of stocks that I think are pretty attractive to potentially buy this week. My most recent purchase ever out of all the stocks I've most recently purchased, the one I just bought was Netflix for the first time ever. Maybe actually, let me do a quick little analysis on this company right here. So Netflix. Oh, our TikTok stream just got taken down because it contains unoriginal content. So RIP the TikTok stream. But anyway, here's Netflix right here. Here's why I just picked up some Netflix shares. I think the risk to reward is starting to look pretty fair to at least maybe nibble on your position by a small amount. So Netflix, it's a company we all know, subscription model company. If you pay for their subscription, why not own some of the stock? And they only trade at a 23 PE. Or what does that mean in English? They only trade at 23 times net income. That or next year's net income. That seems pretty fair to me. And here's actually the data they used to disclose. The last time they disclosed this, Netflix had 301 million premium subscribers, and they make on average per month $11.69 on average per month per paying membership. And literally about a month and a half ago, they just rose prices by $1.99 a month. I don't know about you guys, but just some people are saying I'm still on TikTok. Yeah, TikTok just removed my stream from the For You page. So basically from now on, the stream is just going to lose viewers, unfortunately. So I'm actually going to have to end the TikTok stream soon. If you want to help me out and still continue watching, I am streaming on YT. You can just type into YT Nathan Robert and you'll find it, which is YouTube. But yeah, dang, that's unfortunate. So anyway, yeah, Netflix right here, back to what I was saying though, they're a money printer. If we go to net income right here, they're easily making like 3 billion of after-tax net income every quarter. If we zoom out, this is also the most profitable they've ever been. Look, in 2017, they were making like 300, 400 million a quarter. Now it's like 3 to 4 billion a quarter. They really do just print money every quarter. Whether or not you watch Netflix every month, they still collect that high margin subscription fee every month. So pretty cool. Now's not the time to go all in though. So that's what I'm saying. Netflix is only 0.4% of my portfolio. I eventually want Netflix as like a 2 to 3% size of my portfolio, but I'm not making it 3% of my portfolio today. I only make it 0.4, and this is where I start my initial nibble. For me to go like double my position, I want to see the stock fall 5 to 10% more, and I'm only going to buy more if they fall 5 to 10% more. If this is the permanent bottom and they don't fall from here, then GG, I tried and I still got 8 shares, so I don't really care. But yeah. Okay, so let's see right here. All right. Let's see. What stock do we got next here? Buy back into Hood. What's up, Sean? Yeah, Hood, I'm actually looking to potentially buy more shares. Robinhood and SoFi specifically are 2 fintech stocks I really like. There's Robinhood and also SoFi. I actually just bought another share of SoFi at $15.16. So actually, let's cover Hood over SoFi. You know what? Let's cover Robinhood. This is the stock I have my biggest regret on. Look, if you look right here, I sold 50 shares at $36 a share, and it's 93 today. But I suspect why Robinhood and SoFi are doing really bad is actually because of Bitcoin. Usually these stocks right here, because a lot of their money comes from like crypto fees. And look at Bitcoin from 1 year ago. From 1 year ago, Bitcoin has fallen 50%. And so Robinhood and SoFi have as well, as their crypto volume fees are falling as well. I think Robinhood's crypto trading volume is down like 40% year over year. And you know what? We have that data. So I'll show you the actual data from Robinhood themselves. But I've always had the thesis that instead of buying Bitcoin on the dip, I actually recommend buying Robinhood on the dip because I think they're going to decouple and rally up faster than Bitcoin would. And that's exactly what Robinhood is doing right now. Why are they doing that? It's actually because of their prediction market volumes. But yeah, look at this crypto trading volume year over year. It was 21 billion, but look this quarter, 11.9 billion, down 38% year over year. So that's Bitcoin's down 50% year over year, so their crypto volumes are down as well. But what I'm really bullish on is their event contracts, basically these prediction market contracts, which I never recommend doing because it's pure speculation. But whenever you buy and sell a prediction market contract, Robinhood keeps a 2% fee on that. Whenever you buy and sell a stock, they only keep a 0.1% fee. So these prediction market contracts are 20x more valuable for their bottom line. And that's how I think Robinhood's going to decouple from Bitcoin and do better. And Robinhood's actually doing that. Oh, yeah. We actually have Robinhood perpetual price. So yeah, Robinhood right now, even though overnight market's not open, is $93.93. Not too shabby. Anyway, the tough part is, and actually, I love these fintech stocks as well because they're super profitable. If we go to their net margins, after tax net margin, Robinhood literally keeps 30 to 40% net margins every quarter. So for every $100 that comes in, they legit keep $40 pretty much after tax. And here's their net income, easily making a couple hundred million in net income every quarter. That's why I love Robinhood. They have great margins. They make great net income. But the tough part is buying it today is still hard at a 45 forward PE. So they trade at 45 times next year's net income. That's what makes it a tough buy. I would wait for them to get lower before I'd potentially buy anything significant. So, all right. I'm assuming people said, Prit said GM. I assume you're talking about Good Morning and not GM stock. Thoughts on small modular reactor stocks? Yeah, I'm actually not a fan of SMRs, like these small modular reactor companies, these mini nuclear reactors. If you didn't know, there's only 2 working SMRs in the world, and neither of them are in the US, and no US SMR is supposed to even come online till 2030. So, like, if you go to companies like SMR and NANO, or I think it's called NANO, like Nano Nuclear, they just lose a ridiculous amount of money and they have no revenue. I mean, here's SMR. They had 500,000 of revenue this quarter, 1.8 million last quarter, and they lose a bunch of net income. And the company that even Amazon just IPO'd, I made a video about this, how I think this is going to go straight down from its IPO price. X1 Energy, this is the Amazon SMR IPO. Amazon owns 23% of all the company. They're trying to make mini small modular reactors. They even said themselves, none are going to come online until even 2030. So I'd be real careful here with that industry. So if you want a real exposure to nuclear, like if you love nuclear as the energy, love nuclear, the industry, and want exposure, I would go CEG. They legit own like 38 nuclear reactors that are already working, fully amortized, paid off nuclear plants that would cost like 3 times more to build like today than when they originally built them. So they have irreplaceable assets. So yeah, it's the purest play for nuclear energy. There is no close second. So that's why I actually personally own a CEG. How much do you contribute to your Roth IRA weekly or monthly? Well, it kind of just depends. So I haven't done much. Like 2025 was a great year. I almost fully maxed it out. I deposited 6,300 last year, but so far this year I haven't done too good. But yeah, I am depositing every month, at least $500 every month into the market. Whether it's on, because sometimes like I'll buy an undervalued stock in here, like the other day, like a month ago when I was buying the dip, I decided to buy a share of Amphenol. I also decided to buy a share of Coca-Cola Consolidated. And I was buying the dip in this portfolio instead of my Roth IRA, which I really should be going more into my Roth IRA. So quick question. Where do you look at debt information on Moomoo? I get confused with those terms. Yeah, the debt is always in the balance sheet. So, that brings me, here's a great example of a stock that has a fortress balance sheet that I wanted to cover earlier. It's from my watch list. This is ISRG, a healthcare robotics company. So if you're a fan of robotics and stocks that are on a massive dip, maybe check out ISRG. And let me give you my quick pitch for this one. I promise it'll impress you. I kid you not. Like imagine this, for example. This company, this is the balance sheet right here. It's in the fundamentals tab, financials tab. So if you just go to their balance sheet right here, you can click on it. They legit have 4.5 billion of cash on hand. And then also you can see down here the debt. So current debt, it's blank because they have no debt. The last time they had current debt was in 2005. And we also can find their long-term debt. It's also blank because they have no debt, current debt, or long-term debt. The long-term debt's the nasty stuff. So they literally have no debt, as you can see from the balance sheet, and 4.5 billion of cash. That's literally what you call a fortress balance sheet. And what are they doing with 4.5 billion of cash? Well, you can actually go to the income statement and see if they're making interest on their cash. This is important. This is an important metric to look at because if a company has a lot of debt, you want to see how much interest they're paying every quarter. This company doesn't have any debt though, so they're actually making interest. They literally made $85 million of pure interest on their cash, and that goes straight to the bottom line. It's all high margin. Anyhow, if we just zoom out to this company's net income, this is what you want to see for a stock, for a growth stock that doesn't pay a dividend. Net income grew 17%, literally to a record. It's never been over 800 million before. Just great EPS and net income growth and free cash flow. That's what FCF stands for, free cash flow. Record free cash flow this quarter, and that just goes straight to their cash pile. So this is a cool robotics company. The only unfortunate part is, yeah, they sell MRI scanners and stuff like that. Their instruments and accessories, that's up 23% year over year. And then they have to service these machines. So that's like a recurring segment, 16% of the revenue. That's also at a record up 20% year over year. After grew 15, after grew 10. So this is a really cool growth company at a 43 forward PE. Let's see what Morningstar says. So they are a little overvalued. So that's the tough part. They're trading at a 43 forward PE, but you really want to do an X cash multiple. CEG is in Nancy Pelosi's portfolio. Is that true? Actually, we'll check that out after this. So the company benefits from robust global procedure growth and has a wide economic moat, exorbitant valuation multiples, and looming competitive pressures from well-funded rivals require caution. Anyway, I still really like this one. Here's what the bulls and what the bears are saying. Uptake on their next generation platform should remain strong, given significant momentum to system placement in the next few years. And they're enjoying tremendous success in general surgery, including emergency settings, which now is the highest volume surgical area. Anyway, that's something you want to look into more if you like that stock. So let's check out Nancy Pelosi's portfolio. So yeah, these super investors by law, if they're worth over $100 million, have to disclose all your holdings. So Nancy Pelosi's portfolio, she owns Google. It's a great portfolio. I mean, you should just, copy this. She just it's not like she owns some speculative tiny micro cap. She owns great quality established companies like Google and Apple that are at all-time highs, Nvidia, Microsoft, Amazon, Salesforce. She got Salesforce, I'm surprised. American Express, and we can actually see, she has to disclose all of her exact trades by SEC law, which is pretty interesting. And, same with all these other super investors. So I don't know who some of these people are, but I heard this guy is big on. Anyway, let's see what y'all got next here. Why not sell Path if you're down 1K? I know. I'm thinking about fully selling out of UiPath. What app is this? Hey, I'm actually on a brokerage. If you'd like to get this app, I'm on. It's actually linked in my bio, my profile there. You can just type it into Google, though, a brokerage called Moomoo. But that is an affiliate link if you want to help me out. So Dino said TTEK. Let's check out this stock. And then, Mike said Microsoft. We'll look at Microsoft. I'm sorry if I'm behind on the chat and missing some stocks. I'm trying to get to all these here. Like I see Ouster. What's up, Matt? So in Alibaba, these are some good ones. So here's Tetra Tech stock right here. They're the same prices they were back in 2021. So the stock has been flat for 5 years. That's weird. Maybe they're in the software sector that's just getting hurt by AI. They're at a 17 forward PE, so they're trading at 17 times net income. So Commercial International Group. So that the business is kind of like the growth is choppy. Sometimes it's negative, but at least it's positive, like single digits the past 3 quarters. Their government services segment, that's down 19% year over year. Okay, so this is like the fundamentals are kind of starting to decline. If we kind of combine all the businesses together, revenue fell 7.71%. So that's not great. The lifeblood of the company, the sales are negative. But good news, they are still making, it looks like, close to 100 million of net income a quarter. but I don't like to see negative, sales growth. That's not great. So that might be why the multiple is so low. They're at a 17 forward PE because the business is, on a decline right now. But still, they're still making net income every quarter. Not close to, they're not going bankrupt anytime soon. So, okay, someone said Ouster. Okay, this one I'll be quick with. I would be careful with this one, but this is your LiDAR play. I actually bought this stock just about 2 months ago. It's my second most recent purchase, and I'm super surprised because I only bought 4 shares. I'm up 133%. There's my buy order right there. I bought it during the software kind of sell off, and they got two huge LiDAR sale deals in partnership. So basically, what is LiDAR? It's the stuff that basically controls autonomous vehicles. So autonomous vehicles, like Google's a customer, their autonomous vehicle LiDAR sensor kit sales are up. They also are selling LiDAR kits to drone defense companies. So it detects drones. So here's their website right here. Oh yeah, they have the world's first color LiDAR sensor. Anyway, here's some of their customers right here. So autonomous, it's just in a lot of like sectors I like. So like autonomous vehicles, drones. So here's the revenue forecast, and the revenue on the left is 39 million. It's supposed to grow to 57 million. The why I'm saying be really careful, because I love this revenue growth. I mean, this is what you want to see for a stock that doesn't pay a dividend, high risk, and loses net income. But yeah, they are still losing like 15, 20 mil in net income every quarter. So they're still a money loser. That's why you want to be careful. That's why I only bought 4 shares. All right, so let's do is Microsoft. Someone said Microsoft still long. Absolutely, I am still long Microsoft. They've had a rough week. You're right. Check this out. I mean, this is like a really bad week for Microsoft. A week ago, it was 466. Now it's 388. This is one of my most recent purchases. Reasoning behind buying Uber. We'll look at Uber next. Great question there. And then we'll look at Marvell too. I'll try and get to all these stocks here. Again, I apologize. I'm a little behind. Good to see everyone. General, good to see you, bro. And Mr. Phil. Maya and Sean. We'll look at Palantir too. Yeah, Palantir is great. So here's Microsoft. They are the number one software company in the world. And if you look at any software stock like Salesforce, Adobe, they're getting hurt by the AI thesis. So here's why Microsoft, in my opinion, though, is the best positioned software company, because they are hedged. As an owner, they're saying ChatGPT, OpenAI is going to replace software because Microsoft owns Spreadsheet, Excel, all that. Microsoft owns 29% of OpenAI, or 28%. So as a huge owner of OpenAI, Microsoft is hedged. Also, they're the number two cloud company. So if AI really gets huge, their cloud business will continue to grow as well. Their Azure cloud. That Azure cloud business does over 100 billion of annual revenue. Check out the growth of that over time. And not just their cloud business, but here's their main software business. This is why they're hurt so bad, because they genuinely are the world's number one software company. Their software suite of like Excel, Word, PowerPoint, all that does 120 billion of annual revenue for Microsoft. So they're the number one software company, number two cloud company, and a great AI play with ChatGPT investment. Oh yeah, they're also huge in gaming. They own Minecraft. That was one of their best investments ever. They bought Minecraft for $1 billion. Now, just that's worth a couple hundred bill. They own Activision Blizzard, they own Xbox. So basically, they're an ETF in one. Next quarter, they're supposed to make 31 billion net income. The quarter after, 34 billion of after-tax net income. So they have a better credit rating than the literal US government. So it's more likely Microsoft will repay debt than the government will. And Microsoft only trades at a 20 forward PE, or 21 times next year's net income. For how quality Microsoft is in all the sectors that they're in, that's too cheap to pass up. So I actually decided to buy some Microsoft a couple weeks ago, or a month ago, on this dip back here. And I'll buy more if they keep falling. Especially, I'd love if they go under my cost basis. Definitely buy more. Okay, so let's break. Someone said break down your reasoning behind Uber. Yeah, let's do that. Oh, actually, let me do Palantir first, and we'll get to Uber. And I see UEC. Hey, what's up, Centered, Christ Centered? We'll look at UEC too. I would be careful with that one. But that's a uranium company, I believe. We'll check that out too. So here's Palantir, one of my favorite stocks in the market. Every time I look at this stock, the fundamentals just continue to impress me. There's a reason people love Palantir so much, and that's because they genuinely have amazing financials. 52% of the revenue comes from the government. Check out this growth this quarter specifically. It's the fastest growth rate they've ever grown at. It's up 76% year over year. After grew 45%. After grew 16. So that's literally the fastest growth rate in the entire screen. This is organic growth. So many police stations, the Air Force, the military, all our customers. And then the other half of the revenue is just with commercial companies like Google and GE Aerospace. The commercial side, that grew even faster. It grew 95% year over year. Last quarter grew 81%, 72, 46. So they're like the growth rates growing on both segments. They beat net income projections every quarter. The orange line is what the analysts project them to report, and the blue line is what they actually report, and they crush it every quarter. So, and margins are expanding. So net income's up 300% to 880 mil, and that net margin expansion. Net margin went from 24 to 53. So every time they collect $100, they keep $53 after taxes. That's like royalty streams at this point. Plus, they have no debt. This is a takes a lot of risk off the table. Literal monster balance sheet. Palantir is debt free. So, in terms of one of the best growth stocks, most impressive fundamentals out there, Palantir is that. But you're right, they do have a high PE, but that's not necessarily a reason to, not own them, or at least not own a little bit of them. So yeah, Palantir is at an 83 forward PE, which in most cases is extremely expensive. But think about this, if the net income's up 300% year over year, yeah, what's it going to be the same time next year at this growth rate and with this margin expansion? So they're having this year's like the PE ratio is getting cut in half. You really got to look at a PEG ratio. And then the EPS is still going to grow another 50% the year after and 50% the year after. So there's still like years of EPS growth to come. All right, so Marvell, let's get to Marvell. And actually, let me do Uber first. So Uber, that's another one of my most recent purchases. Someone asked reasoning behind buying Uber. So yeah, I'm barely up on them, 0.27%, but I'm buying Uber because they're a good quality company, and they're still a growth beast in my opinion. They still grow really fast. Valuation's fair, and they're getting into autonomous vehicles. Let's see if there's any news. Uber explores asset sale of Delivery Hero to secure regulatory approval for acquisition. Uber partners with NVIDIA to develop autonomous vehicle technology infrastructure. Wow. Uber opens waitlist for Wave Robotaxi ahead of commercial launch. Anyway, they just acquired Spy Hero, a parking app. They do a bunch of acquisitions. But anyway, if we judge Uber on their valuation, they're at an 18.6 forward PE, which means they only trade at 18 times net income. That's like so much cheaper than the S&P 500. That's way cheaper than the S&P 500. And I don't get it because they still have growth. Here's a super important metric. They're monthly active consumers. So not just monthly active users, but monthly active consumers is 199 million this quarter. At the same time last year, it was 170 million. And their main growth business is actually the delivery side. Delivery business is up 34% year over year. That's the highest growth rate on the whole screen to $5 billion just this quarter. So if we just combine all their businesses and look at revenue, if we zoom out, this is what you want to see for a growth stock. Revenue just grows over time, but not just revenue. So it's good to see revenue growing. How about profits and net income? It's even more impressive. In 2021, it was a tough buy. Who's buying Uber? They're losing 500 mil a quarter. Well, now Uber's trading at 18 times net income and literally just is a money printer. They don't own any, cars, but every time you go book a Uber or Uber Eats, they just collect a high margin fee. So pretty interesting. And I love what they're doing with their acquisition of Spot Hero. They just acquired Blacklane, which is like this high end like limo service Uber thing. I don't know, pretty cool. 18 forward PE just seems pretty fair. I'm only up 0 point, like barely up on them. Perfect. Thank you so much. I missed the balance sheet. I might check out ISRG as well. Hey, what's up, Spray Cheese? Thank you, man. And what's up, Brian Paul? Sorry, I'm a little behind on the chat here. I do apologize. Mine says, I am planning to add some quantum computing stocks like IONQ, D-Wave, and RGTI. I would be really careful with a lot of these. The market loves momentum. My favorite, U.S. government commits $2 billion in quantum supply chain. Yeah, they literally invested some money in like QBTS and RGTI, I believe. But here's the tough part. If we look at the market cap, the valuation, they're saying RGTI is a $7 billion company. So they're worth $7 billion. Here's the tough thing. They did $4 million of revenue this quarter. 2 million last quarter, 2 million last quarter. Like I just can't get to 7 billion. Even if the fundamentals triple, quadruple, we're still a long ways away. Like, look, they still lose. They've lost the most they've ever lost. Like, anyway, the fundamentals aren't there, but you're probably buying them for the swing trade. So those are stocks like the RGTI, QBTS. You really want to day trade, like swing trade those. Hey, what's up, General? He says FPS stock. Yeah, let's check out FPS right here. So this is Forgent Power Solutions. They're a recent IPO. Actually, this one looks interesting right here. So, data centers right now, they can't get connected into the grid as fast as they want. So they're bringing on-site power solutions. They just do their own power generation on the data center site if they can't connect to the grid in time. So maybe this is a company that makes those sort of machines. I don't know. They're seeing explosive growth, and I'm assuming it's from data centers. Revenue's up 103% year over year to 378 million, and they kept $24 million after tax on that. So they are already profitable. Maybe we can go to their website really quickly. So they do equipment and parts is their industry right here. Here's their website right here. Custom products at scale. So yeah, data centers. Yep, there you go. Assuming data centers, interesting. I'll put them on my watch list. Thanks for that one, General. I've never heard of that stock before, but I appreciate that. So, Iris Energy, this one you want to be careful with. I assume this stock will still do good through the end of the decade, but this is still primarily a Bitcoin mining company. Yeah, if we basically, this is at the most recent quarter, 2026 Q3, literally still to this day, 76% of their revenue is Bitcoin mining. What does Iris Energy do? This is why I have trouble. It's a very competitive, commoditized industry. They own a bunch of GPUs and they rent them out. Well, right now, they don't. Mostly what they're doing with their GPUs is mining Bitcoin, but right now they're being approached by cloud companies who need extra compute. They're renting out their GPUs to cloud companies, and that's this other 23% of the revenue. So they're kind of shifting from a tradition, like a boring Bitcoin mining company, to a company that rents out their GPUs. Yeah, Iris Energy secures a deal with NVIDIA. NVIDIA just actually bought shares of Iris Energy. That's what cautions me, because NVIDIA, they do the same thing with CoreWeave. Again, NVIDIA's buying shares of, or giving money to CoreWeave and Nebius, because NVIDIA owns a stake in both of those. They're giving them money, and what is Iris Energy doing with all that money? Spending it literally all that money back on NVIDIA chips. There's like this circular thesis right here, and this isn't like a profitable business either. Next quarter they're supposed to lose 118 mil, 130 mil the quarter after. They're supposed to have good revenue growth, but they did miss on revenue the past 2 quarters by a big chunk. But that's the thing that's scaring me. I'd be really careful with Iris Energy, CoreWeave, Nebius. They'll probably still do good for the next couple of years as long as NVIDIA does good, but that long-term thesis does scare me because it's very commoditized. And even Morningstar is saying, I'm assuming the same thing. What are they saying? So yeah, Morningstar says they're undervalued, highly uncertain long-term demand for AI cloud infrastructure, a subpar user experience compared to peers, and significant capital needs that could dilute shareholders require caution. So yeah, if we go to free cash flow right here, negative 1.3 bill of free cash flow, negative 800 mil, negative 100 mil, and then they're also losing, 100 mil, 128 mil. So it's a tough sell for me from a fundamental side. So hey, what's up? So Baby said Adobe stock. This one, the real moat, their competitive moat, the barrier to entry to this business might be at serious risk here, and that's why I think Adobe is falling. Just kind of think about this, like Photoshop. Here's one thing I saw. No one says, "Oh, that video, that photo, that's Photoshopped." People say that's AI now. Isn't that kind of funny? No people are no longer saying, "Hey, that's Photoshop. That looks AI." But Adobe shifts to freemium AI strategy. Adobe CFO to depart. So the CEO and CFO just departed on Adobe, so that's not a great sign. Anyway, the numbers were actually good. I mean, they traded 10 times forward PE, but basically they're saying in 10 years from now, will we need Adobe as much? Can we just Google Gemini, edit a photo? Like if you have this photo and you say, hey, remove this thing from the background or add a house in the background. Gemini can do that, or AI models can do that. So maybe the demand for Adobe's products will be way less in 10 years. But I'm personally a believer, humans, especially for projects and stuff, humans are always going to need the final touch on art. But that being said, I'd still be extremely cautious with Adobe. I'm personally not buying any. But maybe the worst is in at a 10 forward PE. But yeah, that competitive moat issue is what's hurting Adobe. Have you done Alibaba stock? I've actually not, and I saw some people asking about that on TikTok too. Hey, what's up, Lulu? I'm actually about to end the TikTok stream. Yeah, our TikTok stream got taken off and removed from the For You page and eligibility. So the viewers just go down from here. So I'm about to actually end the TikTok stream. So if you want to continue watching the stream, I'm only going to be streaming from YouTube. My YouTube channel is called Nathan Robert. You can just type into YouTube Nathan Robert. You'll find it. So anyway, here's Alibaba right here. This is like Chinese Amazon right here. If you've heard of AliExpress before, a lot of drop shippers order a bunch of stuff on AliExpress and then sell it. So this is more of of a B2B than a B2C play. Like Amazon is business to customer. AliExpress is more business to business, where a business buys stuff in bulk and then sells it on their own website. But what's cool about Alibaba is, unfortunately, they're Chinese, which sucks, and Chinese stocks always just trade at a low multiple, and Xi Jinping will just like at any moment just like crush the stock. But anyway, their cloud business is growing really fast. If we go to their cloud business, check that out annually. Full year or fiscal 2026, it grew 40% year over year. Quarterly, look at the quarterly growth. And this is in US dollars as well. We've converted it. It's up 45% year over year. Highest growth rate on the entire screen. So Alibaba's low-key getting into like a cloud play. But yeah. So we have converted the currency from Chinese to USD. So revenue of 35 billion, and they kept on that 3.4 billion net income. So they really are making a couple billion of after-tax net income every quarter. And you get a dividend too. You get 1% of your money back in a dividend every year. A 19 forward PE. So interesting there. Yeah, half the revenue is this e-commerce, AliExpress. Then they have this cloud business that's 15%. Anyway, they are on a downtrend right now, but you still want to be careful just because it's Chinese. Basically, they literally are Chinese Amazon because Amazon is the best cloud. The world's number one cloud company, AWS, is Amazon. Also, world's number one e-commerce company. Huge grocery store play, cloud play, robotics play, AI play. So they're like a UPS, Oracle Cloud, Walmart all in one. Amazon's great. All right, so next up, that thinking of taking some profits off Apple and adding it to Microsoft, Google, Meta, Amazon. Hey, yeah, I mean, Apple's really being rewarded right now for not spending on AI. Google's, Meta, Amazon, Microsoft, they're spending tens of billions of dollars on CapEx, but not Apple. They're just actually going to use Gemini for their Siri and stuff. So they don't spend crazy money on a bunch of NVIDIA chips, not paying that NVIDIA tax. But yeah, NVIDIA is great. They sell the iPhone, that's half the revenue. And then their main money maker, their highest margin business is the services business. Every time you buy something in the App Store, like some Clash of Clans gems, they keep a huge 30% fee on that. So a 30% transaction fee on everything in the App Store. So it's all high margin. Yeah, the Adobe CFO moved to Marvel. You're exactly right there. So, let's look at Marvel. This is a custom chip company. I think Google did a partnership with them, and NVIDIA just took an investment into this company. Marvel CEO identifies connectivity as key AI infrastructure bottleneck, emphasizes shift to optical solutions. A huge beneficiary of that is APH in Corning. Amphenol stock. So Marvell to join the S&P 500 index on June 22nd, replacing Pool Corporation. Interesting. Anyway, they are definitely pricey at this point, but there's a lot of momentum around this NVIDIA deal, but they really have improved their fundamentals. If you look a year ago, like no one was buying this stock. They were losing a couple $100 million a quarter, but now Marvell really does print money. A couple $100 million of net income now every quarter. And we're looking at the before taxes. They actually sold off a low margin segment of their business. That's why if you go to the cash from investing activities, it's actually positive 2.4 billion. If this is positive, that means they actively sold out of their assets for cash. And they did. They received $2.4 billion for selling off their low margin business. They're prioritizing this high margin custom chip business. So and they're supposed to make easily a couple $100 million a quarter now. So yeah, the company's strong position in data center optics and custom AI compute chips drives robust growth. Its high concentration in data center spending and intense competition from industry heavyweights require caution. So yeah, definitely be cautious. Let me get my water here, sorry. Yeah, you definitely want to be cautious, especially after this huge rally. But they're getting that S&P 500 inclusion, where so many other indexes follow that. So there's just so much going to be like order book buying on Marvell, prop the stock up even more. All right. Hey, what's up? MRK said thoughts on Duolingo. Let's do Duolingo. Yeah, thanks for moving over to YouTube. I appreciate that. And hey, shout out to YouTube member Jeff Mack. What's up, man? Good to see you. Look at IPI. And hey, someone said Header said I'd rather buy Futu over Hood. I agree. Especially at this exact moment. And I've been doing that. Futu is this international brokerage at a low PE with such great fundamentals. So I just bought like one share at 89 and another 5 shares at 89 or $90 as well on this dip. But anyway, Duolingo, I'm actually sadly not going to recommend buying the dip on because, and hey, Junior, man, hey, Junior, thanks for the Bravo gift. I appreciate that. Sorry if I missed that. But yeah, Duolingo right here. Here's the tough part. Their current EPS, you see, if you look at their EPS multiple, it says they trade at 14 times EPS or net income, which isn't right because they had a one-time adjustment. It says they made 292 million. That was a gap one-time tax benefit. The core business only made 35 million, so they definitely didn't make 290 million that quarter. So when we do a trailing 12 months PE ratio, they're artificially cheap at a 14 PE. So you really want to value them off next year's EPS and next year's net income. And when you do that, it's it sadly makes Duolingo look really expensive. So Duolingo trades at a 40 forward PE. Even on this massive dip, they still trade at 40 times next year's net income. In my opinion, that's really expensive. And this one also, competitive moat might be at risk. So basically, you pay for Duolingo to learn a new language. Maybe in 10 years from now, you won't need to learn a new language. Maybe the live translation technology will be so good. Maybe your Meta Ray-Ban glasses can just live translate stuff so well that you just don't need to learn a new language unless you're forced to in school. Like the need to learn a new language maybe won't be there. And also, you have to pay them money. OpenAI, they fell like 10% on this day. OpenAI is coming out with this free language learning app, and that sent Duolingo down. But anyway, that being said, their subscription business, which is 85% of the revenue, is still, chugging along. It's doing fantastic. It's up 31%, after grew 45, after grew 52, after grew 48. So incredible growth, but again, it still looks rough at a 40 forward PE. Hopefully that was kind of helpful there. But yeah, you still want to be careful. Thanks for doing FPS. Was a decent find. Yeah, that one was pretty cool. I appreciate that. Oh yeah, remind me to get to IFN and Y. Let me get to the newer people stocks first, and then we'll come back to that one. So hey, what's up, Nate? I have been crushed by work, but glad I could make it live. Hey, what's up, Nick? Thanks, brother. I appreciate you. Hope everyone's having a great Sunday, man. Hey, putting in work, put in that overtime so you can buy the dip on great stocks. So Tomboy, what's up? Good to see you, man. Said ServiceNow. So this is a software stock that is one of the more quality ones, but this is another one, kind of like Adobe, where even though they're on a massive dip right now, they still are expensive on a forward PE basis. Where basically, even on this dip, ServiceNow still trades at 47 times next year's net income, which is, being generous, trading it off next year's net income is still at 47 times. That is still a little, like if we get in another huge software sell-off, I think that could easily fall to like a 39 or a 40 forward PE and send this down another 12%. So that being said, don't go all in on this stock yet. Maybe slightly nibble. Like if you want ServiceNow as 5% of your portfolio, definitely don't make it 5% of your portfolio today. Maybe only make it 0.5 to 1%. But here's why they definitely deserve a high multiple. You don't see many companies have this impressive revenue growth, where literally by the quarter, like quarterly, the revenue hits a new record. That's what you want to look for in stocks. If you're just going to buy and hold a growth stock, you want to make sure they're growing and they check that box. The revenue hits a new record every quarter and they're still net income positive. They're still easily are making 400 to 500 million of after-tax net income a quarter, but even making 400 to 500 mil of net income a quarter, they're still trading at 47 times next year's net income. IBM and ServiceNow expand partnership. Oh, check this out. So this is a huge target. ServiceNow projects 30 billion of revenue by 2030. So if we go to their current annual revenue, so 20 billion or by 2030, 30 billion of annual revenue, or 30 billion of revenue in that year. Well, currently they're at 13 billion of annual revenue. So that should be more than a double. I think part of that is going to come from an acquisition, but still, that's insane. And that means there's still a lot of years of growth left potentially. We just hope AI doesn't hurt them. So let's check out IPI stock right here. So this is Interpid Potash. This might be like a like fertilizer commodity company. I don't know. Trio and Potash. Yeah, this might be like for agriculture inputs. Plant cultivation industry engages in the delivery of potassium, magnesium, sulfur, salt. Interesting here. So Potash, that's up 5% year over year. Their Trio is also up 5% year over year. So let's see. Yeah, when we combine that, revenue was 98 million, and on that they kept 7.6 or 7.4 million net income. And well, that's before tax was 6.2 million, so they really did make 6 million of basically net income this quarter. What's the forward PE here? Do they have one? So they trade at 34 times net income currently, which could be a little expensive for a commodity. You know, I know a big player that does the exact same thing. This one you could put on your watch list is CF Industries. This stock could be the potential better play on this industry. You know, they sell all this stuff also that's used in plants and stuff. And you get a 2% dividend yield, agriculture inputs, plant cultivation industry as well. And their PE, look at this, is a 6.8. Could be another one to put on the watch list. Again, these are commodities. And recently there's been like a lot of agricultural commodity inflation. And that's what's kind of benefited CF back here. Back when oil prices, back in the first little Strait of Hormuz oil spike, they rallied up as well because they're a commodity. Anyway, look at their net income, consistently making a couple hundred million in net income a quarter. And at a 6.8 forward PE, actually, I'm going to put CF on my watch list. At a 6.8 forward PE, seems pretty interesting. Okay. Next up, Burnt Chip says OPXS. And sorry, I'm behind here. I'm gonna only spend like 1 minute on each stock. I'm gonna try and scroll through these. I see Circle and ASTS and Celsius. We'll get to all these for sure. Thanks for showing up. We're gonna be live for another hour, so for sure. Oh, hey, Bear. Yo, I'm sorry. I'm not even looking at the TikTok stream. If you're still here, I'll look at Futu stock. Yeah, okay, so I'm about to end the TikTok stream. Actually, I'm going to stream on my other TikTok account. But anyway, move to the YouTube stream if you want to analyze, if you for sure want me to analyze your stock. My YouTube channel is called Nathan Robert. Just type that in, you'll find it. That's the best way to support me. I literally sell nothing. I have no course, book, WhatsApp. I'll never follow you, DM you. I literally sell nothing, and none of this is financial advice. Only way to support me if you wanted to is follow my YouTube, because TikTok keeps giving me a lot of issues. It's the only way to support me. It'd mean more than donating. So anyway, here's OPXS. If you had top right, they're only an $88 million company, but they've done very well in stock. So that's the thing. They're only worth $88 million, but they're on my watch list because check this out. Out of all the companies worth $88 million, I want to own the one that actually makes net income every quarter, because there's a lot of $88 million companies out there and most of them lose a ridiculous amount of money and are going bankrupt. Well, this one actually has basically no debt at all, no net debt, fortress balance sheet, and they make net income every quarter. So they're not losing money. But one thing to note, the revenue did fall 10% year over year. And I don't even know what they do. I'm really just looking at the financials here. So it looks like they're in the aerospace and defense industry, systems that deliver consistent outcomes. Okay, maybe you could check out their website right here. But I like that they make net income every quarter. So Circle and ASTS. You know what? Let's do Circle, because Circle, this is your stablecoin play. If you're a fan of crypto, they have a 30% market share for stablecoins. So if you've heard of USDC, they own that. Circle launches Circle BTC wrapped Bitcoin token on Ethereum to compete with Coinbase. Interesting. All right, well, let's go look at their fundamentals right here. I like that Circle's extremely profitable and they're supposed to stay net income positive. What are their gross margins? Okay, well, they just IPO'd, but check out the projections. Next quarter, analysts project 46 million in net income and then 55 million in net income the quarter after. So they really are supposed to stay consistently net income positive. It says they lost 400 mil this quarter. This was a one-time IPO adjustment fee, so kind of ignore that. But they're supposed to continue to make 50 mil plus in net income every quarter. The tough part is they're at a 77 forward PE right now, which does make them expensive. And I suspect another reason Circle is doing so bad right now is because Bitcoin's doing so bad right now. From 1 year ago, Bitcoin is down 50%. Sadly, even from 5 years ago, Bitcoin has underperformed the S&P 500 by 80%, gold and silver by like 60%. So Bitcoin's underperformed traditional assets, which is unfortunate. And I think one of the better ways to play Bitcoin is buying Bitcoin proxies. Like I buy Robinhood, like a SoFi, a Robinhood. You know, I love those kind of stocks. Futu. I really like these. I love these type of videos from you. Hey, I appreciate you, Eric. Thanks for showing up. Hey, I stream every Sunday this exact same time if you want to hit the follow, subscribe button. So Mr. Phil said Celsius stock. This is like a Monster Energy competitor, you know. And what's cool is they are starting to get really inexpensive. They had a one-time adjustment to their net income this quarter. It says they lost 61 mil. Bottom line is they didn't lose 61 mil. They had a one-time termination fee moving their distribution over to Pepsi. But if we value them off next year's net income, they're only at a 17 forward PE. We're trading at 17 times next year's net income. That seems very fair. Yeah, analysts project 107 mil next quarter, 111 mil the quarter after. So They're supposed to make over 100 mil a quarter. Morningstar says they're undervalued. Strategic expansion through the PepsiCo partnership and the diversification with the Alani acquisition will drive long-term value growth despite a highly competitive environment. Monster Beverage or Monster Energy and just beverages in general are very competitive. But Alani, I see them all the time at my college. I like Alani's and Celsius's. It's like a healthy, or well, not healthy, but like a health, I guess, drink. I don't know. So I guess here's some gross margin. Okay, anyway, cool. At a 17 forward PE, I suspect Celsius is just on such a downtrend right now because all of these like consumer packaged stocks are on a big downtrend as well, like a General Mills, a Campbell's Soup. A lot of just food stocks are on a massive downtrend, even like boring Wendy's. RIP Wendy's, basically, if you go here, you're basically eating at a charity. Wendy's is lower than they IPO'd in 1997. They IPO'd in 1997 at $13 a share. Well, it's $6 a share today at their 2008 dip price right now. All right, next up, I see new to stocks. Can you explain forward PE? Yeah, so the forward PE is just the price to next year's net income. So if something like Celsius was at a 17 forward PE, they trade at 17 times next year's net income. So here's or EPS, which is even better. It's next year's EPS, which EPS is net income per share. That's the metric you want to look at because if they dilute you and issue shares, that's included in EPS, which is net income per share. And if there's more shares that exist, you want to include that in the forward PE. So and it includes dilution. So it's a great metric to look at, in my opinion. So here's ASTS Space Mobile. This one's had a lot of momentum from the SpaceX IPO. And now that SpaceX IPO'd on Friday, this stock on Friday fell 15%. Maybe SpaceX took all the money. I don't know. But is there any news? SpaceX IPO triggers capital rotation away from ASTS Space Mobile and other space stocks. Wow. So Fugazi, that's a funny name, Fugazi. I don't think that's how you actually pronounce it, but we'll call it that. Fugazi Research issues short report on AST Space Mobile, citing 60% Q1 revenue miss and high valuation multiples. ASTS scheduled Bluebird 8, 9, and 10 satellite launch for June 17th on SpaceX Falcon 9 rocket. Anyway, the tough part about ASTS is the valuation. So if you look at the company's valuation, they're at a 24 billion market cap, which means they're worth $24 billion. Here's why that's hard to justify. They did 14 mil of revenue this quarter and they lost 150 million in net income. So they lose a lot of money every quarter. So there's not like a forward net income. Like there's no forward PE for me to look at on this company. That's what's tough. I mean, the forward PE is negative. So a negative 116 forward PE. Kind of tough, but there is a lot of momentum. There is a backlog and revenue growth. There actually is really good revenue growth. So product revenue accounted for 90% of total revenue, primarily from gateway equipment sales. The loss of Bluebird 7 satellite during launch caused a 155 million setback, partially insured. The company maintains strong liquidity and plans to deploy 48 satellites by year end. But yeah, the tough part is they have good revenue growth. Like, look at this. They're basically getting revenue positive for the first time ever. If we zoom out to last year's revenue, 2025, they were doing 1 million of revenue a quarter. In the past 3 quarters, it's really taken off. So you're basically buying this company as they're getting their first ever sort of revenue, and they're still very far away from net income positivity. It does make it a tough story to buy, especially when there's so many stories out there, like great stories as well, that traded only like 30 times forward PE and stuff. It's tough to go with that one on the dip. So I can see why Fugazi is making a short report, sadly. All right. So next up, I see Eric said Zeta, or Zeta Global. They just acquired this advertising company called Marigold, which I'm familiar with. Part of a lot of this is another company. Actually, I'll kind of start this off by comparing it to the ASTS. This is another company. You're buying them as they're making their first ever. Well, this one's different. You're buying them as they're getting net income positive for the first time ever. A few years ago, they were losing 40, 30 mil a quarter. Now they've narrowed their losses to where they're barely losing, 13 mil. They made 6 mil last quarter. They lost 3 mil. You're basically buying them as they're getting net income positive for the first time ever. What's good is they have phenomenal revenue growth. Check that out. Revenue grew 49% year over year to 400 mil, highest ever revenue. If we zoom out, that's what you want to see for a growth stock that is still, has a high forward PE. Yeah, they've done a lot of acquisitions the past 2 quarters. But yeah, if we go to future projections, revenue is supposed to hit 460 million in 2 quarters, up from 337. And they have these super clients, they call them. I'll show you the data for this. Check out this third line, the number 3 here. Customer base expansion included a 19% increase in super scaled customers to 189, with ARPU, or average revenue per user, rising 21% to 1.7 million. So they have 189 customers that pay 1.7 million per year to them. And that metric grew 19%, and the money they're making off the customers grew 21%. So I can see why this stock, um, has done well. But the tough part is that when we do a forward PE, it's 193. They're traded 193 times next year's net income. Again, they're getting net income positive for the first time ever. So that's why you want to be cautious, because they're still, expensive, because they're just not getting net income positive. But that explains away the forward PE. Brooks said CleanSpark. Okay, what's the ticker symbol? I don't know the CleanSpark ticker symbol. If you can give that to me, I'll check it out. So Tomboy said NVIDIA versus Broadcom. Honestly, I like both NVIDIA and Broadcom right now. Here's why it's tough to be bearish. If we zoom out, some people may call me crazy for saying NVIDIA is undervalued after this huge rally. But check this out. If we just value NVIDIA off next year's net income, or a forward PE like we like to do, because that's what you should do for growth companies. You don't value growth companies that are supposed to grow their EPS a bunch off the trailing 12 months EPS. NVIDIA trades at only 20 forward PE. That is not peak bubble valuation, in my opinion. This could easily go to like a 25, 27, 28 before this maxes out and send NVIDIA to a new all-time high. And even at a 28 forward PE, that's not some like ridiculous bubble valuation. But here's why they deserve a higher multiple than a 20, in my opinion. Their margins are ridiculous. They did 81 bill of revenue, and they kept on that 58 bill of net income. They still grew their net income 210%, and they're going to continue to do that as well. On the left, the net income's 31 bill. That's going to grow to 57 billion. So there's still massive EPS growth headed toward NVIDIA. So I know they're a huge company, but I mean, if you buy them today, you should still get like S&P 500 type returns, like 8 to 10% of your money back a year, even buying NVIDIA today. And same with Broadcom. Broadcom's another phenomenal company that, 29 forward PE. It's currently at a 63 PE. It's getting cut in half to a 29 because they're literally doubling their EPS. Here's the net income forecast. In 2 quarters, Broadcom's going to hit 15 billion net income. These are why all these big tech stocks are beloved, because there's still so much EPS growth and the valuations aren't ridiculous. In 2 quarters, Broadcom's going to hit 15 billion. It's never been close to 15 billion net income before on Broadcom. They did 9.3 billion, which was a record this quarter. There's still a lot of net income growth for Broadcom. So they're starting to look attractive to buy the dip on now too. Did you already do ServiceNow? Yeah, we did ServiceNow a little bit ago. So Kumar said Redwire. Oh, and then we'll do CLSK. Thanks for that. Sorry. All right. Let's see. Redwire right here. This one, Redwire, you do want to be careful with this one because actually, I believe they just got some new government contracts. Short seller Fugazi Research published another short report, critical report targeting Redwire and other 5 space companies. Dang. Okay. Well, anyway, I know they got some recent government contracts, and that might be why that stock kind of has been propped up. But yeah, Redwire right here. I don't know. They still lose a lot of money. Like, this is why you wouldn't want to trust anything meaningful. They lost 76 mil, 85 mil, 50 mil, 100 mil. But check out this revenue growth. I mean, it is impressive. 2020 was 12 mil. Now it's 96 million just this quarter, up 57% year over year. But the net income losses do scare me. So there is no forward PE to really value Redwire at. Yeah, negative 24 forward PE. So I don't know though, because I don't know if it's this company or another one. No, is it Redwire that makes the Black Widow drone? They might have like the only NATO approved like drone that a bunch of NATO members are buying. Don't forget wait, let me do CLSK, then we'll do IFNNY. Yeah, I got you, General. What's up, Matt? Yeah. And what's up, Paul? He says Futu. Yeah, let's do Futu stock after this as well. I love Futu. So here's CleanSpark right here. This is still like mainly a Bitcoin mining company. And as we can see, it hasn't really outperformed actual Bitcoin. So at the end of the day, I'd rather own actual Bitcoin than CleanSpark. But yeah, look at this. 100% of the revenue as we see of 2026 Q2, 100% of it is Bitcoin mining. So they own a bunch of GPUs and they mine Bitcoin with it. I wonder if they're getting into renting out these GPUs to cloud companies. They used to have a great balance sheet, you see, but now they've like leveraged up their balance sheet. I'm not sure what they're doing. But yeah, revenue declined 24%. They're losing money every quarter. I don't know. I mean, nothing's really blowing me away here. They haven't grown in stock price. They've been flat for 6 years. So I'd be careful with that one. I'd honestly rather go with like an Iris Energy or like a Nebius, one of those over, I don't know. All right, so yeah, let's do Futu. That's actually the app I'm on right now. So this is an international brokerage, and this company just got fined by China. Basically, 17% of their clients are in mainland China, and they're in trouble because Moomoo allowed people in China to buy US ADRs, which doesn't even seem like that big of a deal. But China does not want people in China buying US stocks. China and Hong Kong and all that was excluded. None of them were allowed to buy the SpaceX IPO either. Moomoo launches prediction markets, trades over 10 million event contracts in the first week. This is another reason why I love Futu stock on this dip. They're artificially on a dip because of the fine they had to pay. The spotlight's going to be on their financials now. I don't think they're going to make any mistakes. They only traded an 8.6 forward PE. So, and as we know, Robinhood stock has done so well because of prediction market contracts. As we know, prediction market contracts have a 2% margin. Whenever you buy and sell a stock on a brokerage, the brokerage keeps a 0.1% margin, but the prediction markets have a 2% margin. So they're 20x more valuable for their bottom line. Moomoo getting 10 million event contracts in the first week. I mean, I'm really excited to see what they're going to pull off next quarter. So this quarter did include their fine. So kind of ignore this huge 61% dip. This included the like $100 billion fine they had to pay. This company always makes like 400 million net income a quarter with literally 50% net margins. That's what I love about brokerages. Robinhood has like a 45% net margin. Interactive Brokerage has a 45% net margin. Moomoo has a 50% net margin. So it's like the picks and shovels place. And yeah, net income is supposed to hit 434 mil, 380 mil. So yeah, they make a lot of money from interest income as well. This is a genius business model. Basically, they give you for free a 3.35, this cash sweep, they give you a 3.35% APY on your cash for free. Whenever you do that, they actually make like a 3.8% APY and they pocket the difference. They give you 3.35%. So they just keep the fee. All right. Will you ever own crypto? Probably not. I mean, maybe once MicroStrategy goes bankrupt, but I like owning Bitcoin proxies, like the brokerages, like Futu, Robinhood, and I own both of those. And SoFi, I own SoFi as well. All right, next up here, what is this? Christian Ronaldo said, "What's Nathan bought these two stocks?" Or wait, I'm not the. Can you look up thanks? ASTC and SPCE. All right, let's check out SPCE. Oh yeah, some people thought this was like the SpaceX IPO. This stock I've like considered shorting myself because this is a classic company of one like if you just give a quick glance at the financials, which I used to never do. I used to just buy stocks that are on a dip and be like, oh, it's got to go up, right? Well, here's one in my opinion that I would not buy the dip on. So if we look at the market cap, that's how much the whole company's worth. They're worth $408 million. You could buy the whole company for $408 million. Here's the thing. Do you want to buy a company you buy it for $408 million? The first three months, it loses 64 mil. The next 3 months, 62 mil, 64 mil, 67 mil, 84 mil. You've lost basically your whole investment in just 1 year. And just for all of eternity, this stock loses hundreds of millions of dollars a year. And if we go to the revenue, you'd think they'd have some, for losing all this net income, they got to be investing it into assets that are making them a lot of revenue. They're like revenueless. The revenue is $227,000, basically no revenue at all, sadly. So that is why I would avoid SPCE at all cost, sadly. So yeah. So let's see what's next here. Oh, I forgot. Hey, you know what? Cool Cat, what's up? I'm actually going to switch my stream to my other TikTok account. Hey, if you're watching this on TikTok, Um, I'm ending it right now. If you want to watch more, go over to my YouTube stream. My YouTube channel is called Nathan Robert. If you go put a stock in there, I'll analyze it for sure. My YouTube channel is called Nathan Robert. We'll continue to stream over there. So yes, I'll see y'all over there. Thank you. All right. So what's up? And yeah, if you give me just 10 seconds here to log into my other TikTok account. I forgot about that. Yeah, TikTok has been giving me issues. Remove me from the For You page and stuff. So, oh my goodness, I don't even know my login to my other account. That's an issue. All right, so yeah. Hey, what's up? Thanks for coming up to the YouTube stream. IFNNY, brother. Oh yeah, what is that one? IFNNY. What's their ticker symbol? And yeah, as we're doing that here, I'll show you my portfolio real quick if anyone's curious. These are all the stocks that I own, my lifetime percent change in my dividend only Robinhood portfolio. I do believe that is the right login. Please, TikTok, can we work with that? So yeah, here's my total percent change in every stock. I'm a big fan of owning like the AI infrastructure plays, stocks like Constellation Energy, the companies that are powering nuclear or that are powering data centers with their nuclear reactors. I mean, I logged in, but it like didn't work. That's weird. All right, we'll try again. How do I get started? I mean, you can, okay, hold on. I gotta open up my Gmail. Hopefully no one can see this. Let me move my phone. Again, I'm sorry. We'll fully back in like just 30 seconds here. If you have a stock you want me to look at, we'll for sure get to all of them in the YouTube chat. I appreciate you. IFNNY, we're gonna look at BKNG, Booking Holdings. Hey, it's that Mason. What's up, dude? And we'll look at MasterCard versus Visa. Yo, MasterCard's one of my favorite stocks to buy right now. Oh my goodness, I have to type in the Gmail code they're sending me now. Okay. Okay. I apologize. I mean, I should not have to bug you guys with this. Okay. If that doesn't work, then I'm just going to give up on it. Okay. Let's get back to the stream here. So IFNNY, this looks like an European ADR stock right here. So they've had a massive rally this past month. I do wonder if, nope, and I logged into the wrong account. Phenomenal. Okay. Give me one more minute here. I can't believe the... Okay, so you know what? I'm just going to do this later. All right. Actually... All right, you know what? I tried my hardest, but TikTok just hates me. So here we go. Finally, we're just going to get back to the stream. So automotive revenue is most of their business right here. I'm actually starting to stress out because of this. Okay, IFNNY. We'll come back to that. All right, so the stock has had a massive rally this past month. Let's see. So they do automotive. Let's convert the currency first of all to USD. So they do automotive business, power and sensor systems. I bet that business is specifically growing from data centers. So yeah, that's up 31% year over year. Very growthy. The automotive segment's up 17%. Green industrial power is up 21%. They have great net income forecast. In 2 quarters, the net income is supposed to hit $721 million. So there's actually a lot of net income growth still to this company. Yeah, if we zoom out, I mean, it used to be a long time ago around 700 million, but to hit 700 million in net income in 2 quarters, that's going to be the highest net income they've had in a really long time. So, all right. We're just going to go back live, I guess, on our main account. So yeah, actually, I like this one because they really are a money printer, making a couple $100 million net income every quarter. Do they pay a dividend? Yeah, you get a dividend as well, a 0.45% dividend yield. So you get like a small yield as well. Anyway, the forward PE of a 44, I would be careful with. Wait, where does the revenue come from? Look at that. So this is like an international stock. They don't have any revenue from America, basically. 28% of the revenue is China, then Asia, then Europe. Oh, USA is 10%. Okay, USA is 10% of the revenue. Let's look at Booking Holdings real quick. BKNG. This is like a travel software company. It's actually a pretty cool company, and they're on a downtrend right now. So you can find, I've looked at this stock for years and I've never been able to buy this stock because they've always been so expensive. And they finally did a reverse split. Like one share used to be like $4,000 a share. Now it's only 164 a share. So a 15 forward PE, check that out. So what that means is they only trade at 15.7 times next year's net income. That seems very fair. You get a dividend yield of 1%. So you get 1% of your money back just in a dividend every year. A 15 forward PE. Net income is supposed to hit 3.5 billion. Yeah, so they really do make good net income every single quarter. What are their margins? I mean, they have basically collecting royalties, 98% gross margins. That's the gross margin ARM has that collects royalties, and Reddit, and net margins of 20 to 30%. So pretty incredible the margins this company has. Free cash flow every quarter of a couple billion as well. So Morningstar has coverage. They say Booking is undervalued. An expanding travel network, robust integration of AI, utilizing massive proprietary data, and strong growth in vertical offerings such as payments and alternative accommodations will drive long-term value growth despite near-term geopolitical headwinds. So maybe no one's traveling internationally right now, but yeah, 15.7 forward PE. I don't see it going much lower than this. The risk to reward looks pretty fair at a 15 forward PE. Looks like they have a bit of leverage though on their balance sheet, but when you collect royalties like this, it's no big deal. I'm sure their margins are sustainable. So yeah, so MasterCard and Visa, I love both of these companies. MasterCard and Visa basically also collect royalties. You know, those small little micro credit card transaction fees that are slowly bankrupting us are making MasterCard and Visa a lot of money. If we go to net margin right here, did you know they literally have a 46% net margin? So for every $100 that comes in, they keep $46 after tax. So, I mean, just incredible. And if we value MasterCard on a forward PE, well, currently they trade at 28 times net income. They only trade at 24 times next year's net income. Oh, Mason got in at Booking Holdings at 212 a share. I'm a buyer here. Yeah, I agree, Mason. It does look like a decent good buy here. Yeah, 24.5 forward PE. Yeah, hey, you're from Trevor's Discord, right? Good to see you. So yeah, 24 forward PE. They're easily MasterCard's making like 3 to 4 billion in net income a quarter. That grows over time. I mean, check out that growth over time. Improving their bottom line, 40, 50% net margins. So what are they doing? So MasterCard makes 3.8 bill to 4 bill of net income every quarter. What are they doing with all that? Well, they pay a dividend, so it's a dividend growth company. The dividend only costs 770 million, so there's a lot of future room for MasterCard to raise their dividend. So the dividend costs 770 mil. What are they doing with the rest of their money? Share buybacks. This is the number one way they return money to you as a shareholder. MasterCard bought back $4 billion of the stock. If you're wondering how does that help you, well, check out this metric. There's something called EPS, which is what you look at as a shareholder. This is the net income per share. People don't realize each share is a living, breathing piece of the company. Like per one share, it makes you as a shareholder, you as a person, technically $4.35 instantly as a return. So if you buy a share of MasterCard for $489, you get $4.35 back a quarter. But you trust the company to reinvest it for you. So you don't get it back instantly as a dividend, but you technically do get that. Well, basically, they can give you more EPS by buying back shares. So the net income grew by 18%, and the net income per share grew faster. It grew 21% because there's less shares that exist. So yeah, in conclusion, I love MasterCard, basically collecting royalties with 56% after-tax margins, 24 forward PE or trading at 24 times next year's net income. Risk to reward's looking very fair. All right, what's up, Brandon? And hey, what's up, Play? Said QQQ. Hey, if you like QQQ, here's a little life hack. Check out QQQM. This is the exact same ETF run by Invesco as well. They just don't market this one. This is this lower expense ratio version. It has a 0.15% expense ratio fee. It's also run by Invesco. It has literally the exact same exact holdings and weightings. The only thing difference is the lower expense ratio. QQQ smart, or Invesco smart, because they market QQQ. They don't promote and market QQQM because it wouldn't make them as much money. Yeah, that's what institutions kinda go in. So someone said SCCO, Southern Copper. Let's check this company out. How's it going, Brandon? So this is Southern Copper. Copper as a commodity, copper cables. There's been a lot of precious metal inflation. You look at gold, silver, copper, like lithium. There's been a lot of inflation or appreciation in these precious metals, and this one's a copper play. So it looks like most of the revenue is like from internationally, but I'm assuming this stock price just follows what the commodity of copper is doing. It looks like they're a money printer. Holy schmoly. Did 1.6 billion in net income this quarter, and that was a 30, commodities shouldn't have margins like this. A 37% net margin, 1.5 billion net income, and they traded a 27 forward PE. Interesting. Although the company exhibits exceptional profitability in a wide economic moat, the significant valuation premium and highly uncertainty rating warrants caution. You get a nice dividend too, 1.75% dividend. So yeah, basically, if you want exposure to copper, instead of just buying the commodity of copper itself, maybe you can buy a company like this, like a copper producer provider that pays a slight dividend as well. Pretty interesting. I know my favorite. I think it's FCX. Is that Yeah, this is my favorite copper play. It's also done very well. Look at this one. Over the past 5 years, they also in net income print, a couple billion a quarter as well. So those are two copper plays. What is USAR? This is USA rare earth, right? So the US government's trying to be more rare earth mineral independent. Is there any news around this company? But what's unfortunate and what makes this a tough sell is because they're still, I believe, revenue-less. Oh no, they're finally making revenue. When I analyzed the stock a year ago, they didn't have any revenue. Check this out. For the first time ever, they did 5.7 million of revenue. 2 quarters ago, there was no revenue, and in 2 quarters, the revenue is supposed to hit 13 million. So you're basically buying this stock as they're getting their first ever sort of revenue ever. Unfortunately, you want to watch out on these net income projections. They're supposed to lose 34 mil next quarter, 38 million the quarter after. So that's one thing to watch. But interesting. I know the government took a 10% stake in MP Materials, so maybe it's like a kind of MP Material play. All right, next up, I see. Oh, Matt said Amazon. We haven't looked at Amazon. Hey, what's up, ISO and Hayden, Jake? Sorry if I'm a little behind here. I'm looking at all these stocks here. BlackBerry stock. Okay, this one has. I'll be super quick with this one because I don't really recommend this one, but it's done great. From literally 3 months ago, the stock went from $3 to $9. It's been a 3x in a month. With that such high momentum, I would wait for it to cool off, but I would still be careful with this one. This is no longer a smartphone company. We can look at the stock in the year 2000. They lost the smartphone war against Apple. In the year 2000, this was a $186 stock, and well, it's a $9 stock today. They have converted, though, to an automotive company, automotive software. This is what Morningstar says. They're overvalued because they've 3x'd in the past 3 months. So the stock's overvalued despite a streamlined portfolio and dominance in the niche automotive software, inflated operating expenses, intense competition from tech giants, and the long runway needed to generate durable economic profits require caution because, yeah, check out the net income right here. It's a little choppy. Actually, the past 3 quarters, though, they are making consistent net income. But if we zoom out on the revenue right here, like that's not what you really want to see as a long-term buy and hold fundamental quality stock. You know what I mean? But maybe they can rebound from here. But I'd be careful after this 3x. But they are still supposed to stay net income positive. So hey, what's up, Rob? How's it going, everyone? Hope everyone's having a good Sunday. If you are enjoying, feel free to hit the like and subscribe. I try and stream every day. Um, so next up, let's look at, okay, Kumar says CoreWeave. I saw another person say CoreWeave as well. That's a big NVIDIA holding. NVIDIA's so big, they literally own some individual stocks. NVIDIA's up like 10x now on their Intel. And CoreWeave is their second largest holding after that. So CoreWeave, this company basically, to keep it simple, and this is really the truth, they just own a bunch of NVIDIA chips and they rent out these NVIDIA chips to cloud companies. Companies like Azure Cloud, Microsoft Azure Cloud, I believe, just signed a little deal with them. Basically, this is the one part of AI where I am a little cautious of, because they're not it's not profitable. It's a really competitive, low margin industry, just renting out GPUs. Here's the net income forecast. They're supposed to lose 670 million next quarter, 600 million the quarter after that. So that's the one tough part. Despite good revenue growth, they are miles and so far away from making any sort of net income anytime soon. And those are the kind of companies I want to own personally. The companies that make net income and free cash flow. Yeah, look at the free cash flow as well. Free cash flow is negative 5 billion, negative 2 billion, negative 700 mil. They're supposed to lose 700 mil in net income for the next 2 quarters. They can't do dividends or share buybacks or do M&A or return money to the shareholder and invest because they're losing so much money. There's a debt problem, there's a depreciation problem. I still think they should, if Nvidia's doing good, they still should do good and continue doing good through the end of the decade. But I'd rather own the company. The picks and shovels plays Nvidia that only trades at a 20 forward PE or 20 times net income. That is why we're not in a bubble. I want to own the company selling the chips to CoreWeave. So Matt says Amazon. Amazon's a company that's almost getting into Amazon space by selling TPUs. Amazon has their AWS cloud and these Titanium chips, TPUs, and they just announced that if they wanted to, this new TPU business could generate 50 billion of annual revenue. Just out of the blue, new business from the past year. This is a literal ETF in one. Amazon expands their less than truckload freight service. They're getting into JB Hunt and CH Robinson's business. They do better than they're basically a Walmart, a UPS, an Oracle Cloud, an AI play all in one. They're the number one cloud company. Their AWS is actually their most valuable business. When you think of Amazon, you think you're getting shipped overnight, that package, but the most valuable part of Amazon that's their highest margin is AWS with 30% net margins. That does 130 billion of annual revenue a year with a $500 billion backlog. And then of course this is actually the world's number one company by revenue. No company does more. It does 750 billion of annual revenue. This is what you want to see for a growth stock where the revenue just hits a new record every quarter, and not just the revenue, but also the profits. So we want to own companies growing, but not just growing revenue, but growing net income. Amazon's the most profitable they've ever been. So I have no complaints. They own Ring Doorbell, they own Twitch, they own Whole Foods. They own 20% of Claude Code, or Anthropic, which owns Claude Code. They own 8% of OpenAI. So that's how they get exposure to trust them. Yeah, if you look in the top left, this is a common buy and never sell portfolio, because once I buy a stock in here, I literally never sell it. I diamond hand it. I saw someone asking about Adobe. We kind of just covered Adobe like 20 minutes ago. Basically, point being, so we're not going to cover them. Hey, Invested09, dude, I forgot to say thank you for the cool little soccer gift and the golden glove. Thanks for that. If you're in here, Invested09, I'll check out a stock if you have one. But yeah, Adobe is getting hurt by the AI thesis. Basically, Adobe, Photoshop. No one said, funny thing, no one says, hey, that looks Photoshopped. People now say, hey, dude, that looks like AI. No one says that's Photoshopped anymore, which is kind of crazy to think about. But the thing is, you use Adobe, like they're saying in 10 years from now, will we need Adobe to alter photos? Because you can just Gemini create a thumbnail, or Gemini create a logo, or ChatGPT create one. Or like you use Adobe, you're like, hey, can you remove this thing from the background? Or can you add a house in the background? Google Gemini stuff can do that. I am still a believer that humans are always going to need the final touch on art. You can't just rely all on AI to do it. So I use Photoshop every day still. But that's the one thing that's scaring me from the stock. Do you have a growth watch list? I don't know. Here's the watch list of stocks I think are a great buy right now. Not financial advice. SoFi, Microsoft, Reddit, Netflix, Uber, and ISRG. These are some really great ones. Hi, just listening for ideas. Hey, thanks, man. I appreciate you. I'm seeing some interesting ones there. Howmet Aerospace, HWM. So I love the aerospace and defense sector. So, wow, this one has done phenomenal, with all the war fears. Buying an aerospace and defense company like a Raytheon or a Moog or a Howmet Aerospace could insulate your portfolio if war fears start to escalate. Looks like they sell engine products, fastening systems, engineered structures, forged wheels. And check that out. The revenue's the highest growth rate on the whole screen. It grew 19%. and the net income grew 68. That is pricing power. That is pricing power by definition. So the revenue, the sales are up by 19, the net income is up by 68. Look what that did to the net margin. Same time last year, the net margin was 17. Now it's a 25% net margin. So this stock isn't just at all-time high because of momentum. The fundamentals are genuinely improving. And basically that's why I look at the financials, because it usually explains why a stock's at all-time highs or why a stock is at all-time lows like Lucid. I mean, that's why I focus so heavy on financials. So look at Lucid right here. It's at an all-time low. Someone just said, Lucid, we're not going to cover this one, but I can explain to you why this stock is at an all-time low. Let's just go to net income. Basic net income metric right here. They literally lost $1 billion this quarter, 800 mil, 900 mil. For all of eternity, Lucid just loses close to $1 billion in net income every quarter. So every 3 months they lose $1 billion. The whole company, look at this. You could buy the whole company of Lucid for $2 billion. Let's say you do it. You buy Lucid for $2 billion. Within the first 3 months, they lose $1 billion. And then 900 mil the next 3 months. So there's almost for sure bankruptcy risk at Lucid. My prediction, Lucid is going to go bankrupt. So, or not financial advice, of course, but those are the companies I stay away from. So what's up? I'm sorry if I'm a little behind. I see so many great stocks. Thank you to everyone who's showing up today on the stream. I stream every Sunday at this exact same time. If you'd like to hit the follow button, I promise I sell literally nothing. I just had to ban someone with the same username and profile picture as me. I have no course, book, WhatsApp. I'll never follow you, DM you. I literally sell nothing. I don't coach. The only thing I do have, if you want to support me, is a YouTube channel. It's the only way to support me. It'd mean more than donating, just to subscribe and watch from my YouTube channel, because I'm trying to build that up. My YT is called Nathan Robert. You can just type that into YouTube YT. We finally got the TikTok stream back up. Thanks to everyone. We're streaming on YouTube and TikTok. So, hey, what's up, Keith? He says, I appreciate the live analysis on stocks. What are your thoughts on Amphenol at current prices? I love this stock. This is the company, and I have been recommending this stock every time they fall to like this $130 level. Those Bs, that's where I bought the stock at. I just bought this one a month ago. This is the copper cable provider for and fiber optic provider for Google's TPUs and NVIDIA. So NVIDIA's NVLink Spine uses Amphenol. It uses like 2 miles of copper cables in this little box. Amphenol provides those. And APH. So I'm always a fan of buying the AI infrastructure plays. Instead of just buying NVIDIA, own the whole ecosystem. Buy the companies doing the MEP work, the complex electrical work. Buy the companies doing the HVAC work. Buy the companies providing the copper cables. And that's Amphenol right here. And so that's why they've had a nice little bump up this past month. And here's the crazy part. Even though they've done really great this past year, even at this close to all-time high level, they're only at a 28 forward PE. That's how you value growth companies, off next year's EPS and forward PE. Amphenol only trades at a 28 forward PE, or 28 times next year's net income. Their main business, communication solutions, this is growing so fast. It's up 88% year over year. After grew 90%. This is what justifies the high multiple, in my opinion, because the fundamentals are improving so good. Harsh environment solutions, that's up 33%. This is subsea cables. They provide, if anyone's heard, the internet is really run off these underwater subsea cables. Amphenol's the one that actually Meta's creating a new like $10 billion line using partially Amphenol. So anyway, this is the copper cable provider, S&P 500 company, 28 PE, and a 0.5%, or actually a 0.7% dividend. You buy the stock today, you still get a decent yield, 0.7% of your money back a year. Full disclosure, I'm totally biased because I own that one, but I own them for a reason. And actually, I continue to raise my cost basis. Here's where I bought my shares for the first time ever. So my average cost, that's the orange line, is $71 a share, my average cost basis. I continue to buy more and raise my cost basis because they're even though most people won't do this, they won't raise their cost basis. I do, because even though they're up so much, only at a 28 forward PE, they're still undervalued. So I would be up more, but anyway, let's see some more here. I buy Meta 5. Oh, Meta? Dude, actually, I own Meta as well in my, face. Okay, didn't want to scan my face. Meta, I got 5.1 shares of in my Robinhood portfolio. I'm up 7.6% all time on Meta. And Meta is being punished right now for spending a lot on AI. But that's not scaring me out of Meta, and I personally think Meta is one of the best stocks to buy now, not financial advice. Meta trades at an 18 times net income. This is why I don't see it getting much cheaper. I don't see Meta going to a 16 or 15 forward PE. In my opinion, we are close to the bottom on Meta, not financial advice. They literally have pretty much half the world is on a Meta app once a day. They have 3.54 billion daily active users. They just disclosed their average Facebook user a year in the US makes $50 a year. So here's what Meta makes in net income. They easily make 20 to 24 billion of net income a quarter. So this is a great business. Their core advertising business from Meta ads, Facebook ads, Instagram ads, now introducing ads to Threads and WhatsApp should be a nice tailwind. That core business, I believe, is going to benefit from AI. But what sucks is their core business is generating money. They're making 20 to 25 bill a quarter. They are spending more than they're making in CapEx. They're spending 30 to 34 billion a quarter, and they just projected to spend 35 billion for the next 4 quarters in a row. So they're spending more than they're making. So Meta actually now has a net debt position for the first time in history. But again, that's not scaring me out of Meta, especially at a 18 forward PE. And their top line revenue, just sales, grew 33% year over year. I love what they're doing with the Meta Ray-Ban glasses. They have an 88% smart glasses market share. So anyway, Meta partners with Reliance to lease first data center. Anyway, Meta's really cool. I do own them, so I might be biased, but I own them for a reason. Dang, yeah, my phone is getting low, 7%. Actually, I'll probably have to go grab my charger in a minute. Thanks for telling me, Rob. What's up, man? Yeah, long Meta. Yeah, some people like to buy options and stuff. I'm just a fan of boring shares. Just buy shares of Meta. I even bought a fractional share. I own 5.1 shares. I don't mind. Yeah, I try to be fully transparent. I go to a bunch of other streams. No one shares their total portfolio. Here's my lifetime percent change on every stock. Like, here's my Webull portfolio as well. Someone said, can you show all your stocks? I'm not, but because I already did that a bunch of times, and I don't want to re-go over that and waste everyone's time. But yeah, here's my lifetime performance in here, up 26% all time. I got here are my biggest winners in here. AMD's been my best performer, up 300%. We've seen a huge hardware rally, but we are still down bad on a lot of software, like UiPath is down 50%, Sprouts Farmers Market, Progressive. Our newest purchase ever, my most recent purchase, if you're wondering what is it, it's actually Netflix. I just bought them 2 days ago for the first time ever. I'm nibbling. Now's not the time to go all in on Netflix. Like, I want Netflix as 4% of my portfolio. It's not 4% of my portfolio today. It's like 0.5%. I'm only going to buy more Netflix only if they fall 5 to 10% more. And if they don't fall 5 to 10% more, and this is the permanent bottom, then GG, I tried, and I still don't care because I still own shares. All right, so I'm so behind on the chat here. I apologize for everyone if I'm missing your stocks. I see a lot of great ones. So Tex says WQTM. Oh, I see Oscar Health. I want to do Oscar Health. Okay, so I have not Wisdom Tree Quantum Computing Fund. Oh, this is an ETF right here. So basically a basket of stocks. So let's see what stocks it owns. So it owns QBTS, RGTI, IONQ, IBM. Yeah, IBM's a great. IBM and Microsoft are low-key my favorite actual quantum companies. Actually, Google as well. Google has a quantum supercomputer that's like ahead of everyone. They have a whole presentation on it. Google, obviously not a pure quantum play. But anyway, if you don't know which quantum stock to pick individually, this ETF just breaks your money up for you and diversifies it into a bunch of quantum names. Could be a safer, more disciplined approach than just buying one. So your diversification is great. DRAM, yeah, DRAM, I believe that's the memory ETF. So yeah, I love ETFs. It's basically a sector ETF play. So if you've heard of this memory shortage, like you've heard of Micron, you've heard of this RAM shortage, SSD hard drive shortage because of data centers. Well, this is an ETF right here that breaks your money up for you into all of the top memory companies like SK, Samsung, Micron, SanDisk. So yeah, it's more diversified, more disciplined and diversified approach to buying as opposed to just one brokerage or app name. Yeah, hey, if this app I'm on, if you'd like to get this app or it's a brokerage, it's actually linked in my profile, brokerage called Moomoo. You can just type into Google Moomoo, or if you want to use my affiliate link, I actually have it linked in bio, linked in profile there. If you sign up with that link and deposit $100, I think we both get like a free stock. When I signed up, I got like a free share of Ford, and then I just like instantly sold it. But yeah, free app, literally costs nothing. There is no fees. My favorite way to analyze and buy stocks on. And you get it for free, 3.35% APY. Someone said Futu stock is so cheap. Yeah, this app I'm on right now, the literal app I'm on right now, this is their stock right here, Moomoo in the top left. This company is a money printer. They have 30 million users. They make, a couple 100 million of after-tax net income a quarter. Even if this brokerage were to go bankrupt, you're still FDIC and SIPC insured for 250K, but it's good to see the brokerage actually prints money. The main way they make money is because of their interesting proposal. So most of the revenue is interest income. That's half their business. Here's what they do, what makes them unique. For free, this app gives you a 3.35% APY on your idle cash. They earn like a 3.8% APY, and they pocket the difference. All right, let's keep going here. Yeah, anyway, if you want to get this up, I'm on LinkedIn profile, LinkedIn bio there. You can look at all the super investor portfolios, do prediction markets if you wanted. Okay, do SpaceX, please. Yeah, SpaceX just IPO'd. So I only have one candlestick of data here, but on Friday, they were up 19%. Great day. We want to see SpaceX do good. We want to see the momentum do good because it props up a lot of other stocks. So Morningstar says they're overvalued. The core space and satellite business possesses deep cost advantages. The highly uncertain viability of the newly acquired AI segment, XAI, combined with aggressive market pricing and dual-class government risks warrant extreme caution. So especially at a $2.1 trillion market cap, the risk reward does look tough on SpaceX. If you buy a share today, for you to double your money, they have to be worth $4 trillion. So it is a tough double. Especially, we don't have much metrics to understand. They lost $4 billion net income this quarter. So that's the one thing you want to be careful with. Yeah. Hey, again, yeah, if you want to get this brokerage or this app I'm on, linked in my profile bio there. Yep. So did you take profits on FIX, and are they a long-term hold? So no, actually, this is my experiment portfolio. If you look in the top left, it's called my buy and never sell account, because once I buy a stock in here, and I have other portfolios where I don't do this, but once I buy a stock in here, I'm literally never allowed to trim or sell a single share. It's been tempting, like Powell Industries, I'm up 1,000% on this company. Cover Systems, I'm up 18 grand on. I've literally never once sold or trimmed. Let me get my charger. Okay. I didn't realize my phone is getting so low here, so I had to grab my portable charger. Okay. All right. So yeah, Comfort Systems, this is your HVAC player. They do HVAC and MEP work, specializing in data centers. So let's do Oscar Health. This is your health insurance, life insurance play. Medicare, Medicaid one specifically, I believe. So they kind of follow whatever UNH is doing, or United Healthcare is doing, and they've had an incredible rally this past couple weeks here. Same with United Healthcare. Is there any specific news? No. But what I love about Oscar Health is how fast they grow their revenue. You won't believe this, but just check this out over time. This is what you want to see if you're just going to diamond hand a stock. Incredible revenue growth. Just this quarter, it was $4.65 billion. Did they make net income? And they made $680 million net income. So every year, this is like their only profitable quarter, Q1 every year. Q1 is the quarter every year where they make net income. All the other quarters, they kind of lose money. But but now check out next quarter. They're actually supposed to make $105 million next quarter. So they're going to get more net income positive. And the forward PE is a 21. So they trade at 21 times next year's net income. I can see why they're doing pretty good. Morningstar says they're undervalued though. But I can see why they've had such a nice rally. That doesn't seem like a peak valuation. You know what I mean? So C Limited SE stock. So this is like an international, I think Asia specific, like Amazon company. Where's the revenue come from? Yeah, Asia. So Southeast Asia, excluding Singapore. So this is like an e-commerce and fintech app in mainly Asia. So it's not a US company, The US is basically none of their revenue. So it's a pure Southeast Asia play for e-commerce and fintech. And they have phenomenal top line growth. Check this out. This is what you want to see. I mean, literally revenue hits a new record every quarter. Revenue grew 46% year over year to $7.1 billion. And on that, they kept $430 million in net income. But that looks like the margin did decline though. So the revenue grew 46, the net income only grew by 6. So yeah, if we go to gross margins fell by 4 and net margins fell by 27. That's why I think the stock might be struggling, because the revenue is growing very fast, but the margins aren't keeping up. But still, wow, look at net income projections. It's supposed to hit 544 mil. So that's the highest ever. It's never been close to 544 mil before, has it? No. So yeah, they're supposed to hit record net income and record EPS. But when we do a forward P, actually, They're cheap on a forward PE. They're trading at 19.8 times forward PE. Honestly, I think we're getting close to a bottom on this company. I can understand why they've fallen because of the margin compression, but the worst could be priced in at this low of a multiple. You know what I mean? Interesting there. So, hey, what's up? User said, oh, Hims stock. Okay, let's do Hims. This one is seeing a lot of competition from Amazon. To put it simple, and this is what they do basically, you order your weight loss and hormonal prescriptions from their website, and they just deliver it to you. And basically, Amazon does the exact same thing now. Hims used to be like the only platform you'd go on to buy weight loss pills and weight loss injections. And as a couple months ago, Amazon now sells both of those. Wegovy pills, Ozempic, they're all on Amazon now. Amazon Pharmacy. So basically, the tough part is it's kind of becoming commoditized and the valuation isn't cheap. Look at this forward PE. I mean, a 730 forward PE or 730 times next year's net income, their margins are actually going down. So, okay. So, yo, by the way, please go to my YouTube channel. I just got your live contains themes that may find uncomfortable. Your live stream has been restricted for body exposure and sexualized behaviors. So if you want to support me, I'm going to have to end the TikTok stream. Please go over to YouTube. My YouTube channel is called Nathan Robert. If you say your stock over there, I'll for sure analyze it. But but back to Hims. Yeah, I don't even know how that's possible that we're getting in trouble. But yeah, the revenue only grew 3.7% year over year, and they lost 92 million net income. Gross margins declined by 11%. Last quarter fell 7. So there's a lot of reasons why I'd actually be very careful with Hims. Competitive industry, super high forward PE, margin decline, revenue slowdown, net income negative. So yeah, see, I don't know, Tex. Yeah, yo, I don't know how that's even possible. TikTok is just making up reasons at this point. So yeah, guess I'm in trouble. Yeah, if you want to support me, please go to the YouTube stream. Guess we're getting cooked. We got 86 viewers on the TikTok. If you want to help me out, yeah, head over to YouTube. I'm trying to build up my YouTube channel. YouTube never gives me any issues. YouTube's called Nathan Robert. So Confused said AMKR stock. So this is Amkor. This is actually a data center component company. So selling random components that data centers would use. So they're at an all-time high right now. So yeah, they're at a 47 PE, but they trade at 38 forward PE, so there is still a lot of EPS growth. And notice for the past 3 quarters in a row, yeah, YouTube channel name, thanks, Jay. Yeah, my YouTube channel is just called Nathan Robert, same as my TikTok name. But yeah, just type into YouTube Nathan Robert, you'll find it. But notice the past 3 quarters in a row, they beat on net income by a huge margin. The orange line's what the analysts predict, the blue line's what they actually report. And if they beat on net income every quarter, they're probably going to continue to beat in the coming quarters as well. So the forward PE might be even lower. You get a 0.5% dividend yield. And yeah, they say they're in the semiconductor equipment industry. Its services include design, package, characterization, test of wafer bumping. So anyway, I don't know the exact stuff, but semiconductor equipment, it seems like the industry. SpaceX fair value is $63. I'm glad I don't have any NASDAQ tracking ETFs. Yeah, SpaceX IPO is definitely high, but here's one reason SpaceX is doing so good right now is because there's something called float. Only 1% of all the shares are like available to trade. And the IPO is like 4x oversubscribed. There's basically no sell orders. And in 1 year from now exactly, there's going to be 40x more shares available than there is today. And so there's going to be a lot more selling pressure. And so basically that's why a lot of IPOs get propped up at the very beginning. Same with Webull when they first IPO'd. Only like 1.7% of the shares were available to trade. And basically there were so many buys and so little shares selling on the sell book that the stock just rallies up like crazy. But then some more shares get unlocked in the future. So, okay, Johnny, or wait. Yeah, I don't know. Yeah, Brian, I don't know. I guess TikTok doesn't like me. So Johnny says GIS General Mills. So if you look at any consumer package stock right now, or like packaged food goods, they're getting crushed right now. And it's not just General Mills, it's the whole industry. Like look at Campbell Soup, which owns, all the soups and Goldfish and a bunch of snacks and stuff. Campbell Soup stock looks almost identical to General Mills. And I really like General Mills because they're very diversified. Check this out. They're in snacks, they're in cereals, they're in convenient meals, pet food, dough, Pillsbury dough they own, baking mixes and ingredients. And they're getting very cheap, trading at like legit 10 times net income. So, yeah, hey, Marwan says you need to tap to help the algorithm. No, the algorithm, I just got taken off the algorithm. I don't know if people on TikTok can see this notification, but I've been my stream is restricted for body exposure and that behavior. So I don't know, but yeah, 11.4 forward PE. So they're basically trading at like 10 times net income, starting to get very cheap. So the other part is Wendy's is getting hit as well. I feel bad for the QSRs, the quick service restaurants. Look at Wendy's stock. And this isn't the weekly, this is the daily chart. They're down like 50, 60% just in the past year. Wendy's is lower than they IPO'd in 1997. They IPO'd at $14 and they're $6 today. And in my opinion, my favorite way to play this huge sell-off in the food industry has actually been McDonald's. I made them now one of my biggest positions. It's a great dividend growth stock as well, but I'm only up 0.9% on McDonald's, and I have 20 shares of McDonald's now. And that pays me $38 in dividends a quarter, which is pretty cool. Tax free. If you make under 48K, long term capital gains is 0% for you, and qualified dividends are long term capital gains tax. And so that's 0%. So even in a taxable account, no matter the state, if you make under 48K, qualified dividends are tax free. But anyway, McDonald's isn't as much as a restaurant as like a Wendy's and Starbucks as they own all their stores. McDonald's is mainly a franchise business where they own the land under 80% of all the McDonald's stores. They own the land under them. So each franchise pays rent back to the corporation. They're in the top 10 most valuable real estate portfolios in the US. And also they collect royalties, sales and marketing royalties. It's 4 to 5% depending on the store. But yeah, basically 4 to 5% of every transaction goes back to the parent company as a royalty. So that's why McDonald's isn't really a restaurant. It's a fascinating business model that's usually recession resilient. 30% plus net margins, nice little 2.55% dividend yield, and a 20 forward PE. That's where I'm buying. All right, so let's see what's next here. Oh, SanDisk or Backdoor. Actually, let's look at hold on, can't type. DTCR. Oh my goodness, I can't type. A Global X Data Center and Digital Infrastructure ETF. Yeah, that's a sector I want exposure to, and I basically pick and choose my own, infrastructure plays. So yeah, they own Equinix, the data center REIT, Digital Realty. They own a lot of REITs in here, like American Tower and Crown Castle. Those are cell tower real estate investment trust. Then they have Marvell, SK, Micron, Applied Digital, SBA, another REIT. Very interesting. Cool there. That one probably has a decent dividend yield as well. I'd buy up CPGs ASAP. Wait, what is this? I'd buy up. Stay away from grocery retailers right now. Too many sweet changes. Hey, what's up? Oh, wait, talking about Campbell's Soup maybe? Can you do comp and serve? Here, let's do Compass right here. So I believe this might be a blank check holding company. Or no, they're a brokerage. Huh. They're actually a brokerage, and I like the brokerage industry. There might just be a lot of competition. Robinhood's really big, Webull, Moomoo, but they did 2.7 billion in revenue, but they only kept legit 22 million in net income on that. Like Robinhood, Interactive Brokerage, they all have like 40, 50% net margin. Same with Futu, 40%, 50% net margin. SoFi is like a 20% net margin. Looks like this company's net margin is really choppy, low single digits or even sometimes negative. So I guess that's the one thing I'd be careful with. So they're actually not like they're a real estate brokerage. So not like a brokerage as you and me think, a fintech brokerage. Looks like they sell houses, something like that. Anyway, real estate brokerage makes sense. The real estate market, I bet that stock is struggling because of real estate and interest rates. If you look at any real estate or interest rate sensitive sector, or even the home builders like Lennar, the main home builder, they are down bad from their peak a year and a half ago. Home Depot and Lowe's are struggling very hard as people aren't upgrading and spending on their houses. And look at Lowe's the past couple months here. So, that industry is struggling. Here, I'll show you the exact interest rate cut probability numbers from the FOMC. So, macroeconomic data here. So, check this out. If we go to the October meeting, so this is literal from the Fed dot plot meeting. In the October FOMC meeting, there's a 61% chance of no interest rate cut, but then there's literally a 33% chance of a 25 basis point hike. So, there's literally markets right now are pricing in, and bond market is pricing this in right now, a 33% chance, and then technically a 38% chance of a rate hike in October. So that's what, instead of a rate cut, they're expecting a rate hike. So that's one thing to be careful with. Oh yeah, here's a lot of themes. One day I want to just go through all these themes and find out, hey, what are the best, optical communication stocks and nuclear power stocks and stuff like that. Pretty cool. So anyway, that's cool. Let's keep looking at y'all stocks here. I know you probably talked about it. What are your thoughts on SpaceX? Yeah, basically, I'm kind of in the same boat with Morningstar right here. I bet SpaceX, I'm bullish for maybe the next, couple weeks, 2 weeks, as like the low float will prop this up. I want SpaceX to do good, but I am staying away and not putting any of my own money into it. Morningstar says they're significantly overvalued, while the core space business and satellite businesses possess deep cost advantages. The highly uncertain viability of the newly acquired XAI segment, combined with aggressive market pricing and dual-class government risk, require extreme caution. The valuation of SpaceX is $2.1 trillion. So if you buy a share today, for you to double your money, they have to be worth, 4.2 trillion. And, it's just tough to trust because, they're technically a money losing company. They lost, we only have 2 quarters of data, but they lost 4.2 bill that quarter, 500 mil last quarter, 4.6 bill of revenue. There's so many other, like Meta is lower market cap. Meta makes 20 plus billion of net after tax net income a quarter, and their revenue's up 33. I'd rather buy Meta than SpaceX, but there's just so much hype around it right now. So, oh, hey, actually, oh, yeah, Open Door. Yeah, this is one you definitely don't want to buy as well. I think this is another like real estate brokerage. What Open Door does is they flip houses. They buy houses and they flip them and sell them themselves. This does great in a low interest rate environment. Like, look at 2021 when rates were zero and everyone and their dog was buying a house. Look at this. The revenue growth was literally like 500% a quarter. They were doing 4 to 5 billion of revenue a quarter. But then as rates hiked up in 2 years, look what that does. This shows how interest rate sensitive they are. Well, plus they're bad at flipping homes. I've been to some before. The huge revenue declines, down 71, down 70. And now the revenue's the lowest it's ever been, or lowest it's been in years at only 720 mil. This one's very interest rate sensitive. And the bad part is they're a big money loser. They lost 170 mil, 1.1 billion, 90 mil. So Open Door is just not the kind of stock I'd want to buy. I'd rather buy a Rocket Mortgage over that one. Hey, Fishy, we'll get to ServiceNow after this. Let me do SoFi, and then we'll do ServiceNow. I got you. ServiceNow after this, Fishy, for sure. Okay, so here's SoFi Technologies. I actually just bought another share of this company at $15 a share. A lot of people hear SoFi, they think it's some meme company, but SoFi is no meme. This is a very high quality, they're a very quality growth stock, in my opinion, and they're at a fair valuation. I'll start with this first. Growth companies, we want to value them off next year's EPS and not the trailing 12 months EPS. SoFi trades at only a 23 forward PE, which means they trade at 23 times next year's net income. The main thing SoFi does is loans and lending. Their lending business is so growthy, the growthiest it's ever been. It's up 55% year over year to a new record. So that justifies a 23 forward PE. And if you go to the other half of the business, the financial services, the brokerage, fintech platform, that's up 41, after it grew 101, after it grew 85, after it grew 244, after it grew 264. I mean, just phenomenal growth. If you're going to own a growth stock with no dividend or anything that slightly dilutes you, you want to make sure they're growing very fast, and SoFi checks that box. I mean, revenue's legit up 42% year over year to 1.1 billion, and on that, they kept 166 mil in net income, up 134%. So they actually expanded margins. Net margin went from a 9% to a 15% this quarter. So for every $100 that comes in, they keep $15 after tax. And check out the future projections from analysts. They're supposed to make 240 million of net income in 2 quarters. So there's still a lot of net income and EPS growth for SoFi to come. That's why I actually just bought another, I actually rose my cost basis. I bought another share of SoFi on the dip. It's still one you don't really want as a super meaningful size position, but you still maybe want as a position because I like the growth there. So ServiceNow, and then we'll look at, BDCs. Yeah, like Blue Owl. Those are the companies that have to pay out most of their earnings in a dividend. We'll check those out after this. I love Main Street Capital, my favorite. We'll check that out after this. So here's ServiceNow right here. They just gave a 2030 prediction. But right now, if you look at any software stock like Adobe, Salesforce, Duolingo, they're on a massive downtrend, and ServiceNow is no exception because they're a huge software company. But they're one of the most quality software stocks. And I'd look into this one. They actually just gave guidance of 2030. So in the year 2030, they're going to project 30 billion of revenue for that year. Let's look at full year 2025. They did 13 billion of revenue. So they're expecting the revenue to more than double in just 5 years. And first off, ServiceNow is extremely impressive. Like, you don't see many companies do this, but literally by the quarter, the revenue hits a new record. Insanely good growth, and their net income positive. So not just revenue growth, but net income positivity, easily making now like 3 to 400 or 4 to 500 million of after-tax net income a quarter. But the tough part is, even making 4 to 500 mil a quarter, they trade at 60 times net income. And they trade at 47 times next year's net income. And that's what worries me. If we get another huge software sell-off, this forward PE of a 47 could fall to like a 37, worst case scenario. And that could mean this could fall another 20%. So that's why now is not the time to go all in on ServiceNow. You'd want to nibble or be very cautious, slightly buying today. But if they can pull off this 30 billion revenue by 2030 on AI monetization, I mean, that's a lot of growth that deserves a high multiple like they have. So, yeah. So someone said BDCs. Inca said BDCs like ARCC and Blue Owl. So what is a BDC? That stands for a business development company. Dividend investors love these because literally by law, they have to pay out 90% of their taxable income in the form of a dividend. So whenever we look at their yields, like Blue Owl here has a 9.3% dividend, it's actually sustainable because of how they are, because of how they're formed and taxed. So unfortunately, the lending business has not been too strong right now. Out of all of them, so Blue Owl, they basically do first lien loans, second lien loans. Main Street Capital does that as well. But what makes Main Street Capital a little different is that they take equity and preferred shares into the companies they loan to. So they have equity in the stocks that they loan to, and that gives them good appreciation on that. But anyway, this whole sector is kind of being hurt because whenever the PE, PC, like the private equity, private credit shenanigans happened a couple months ago, the BDCs, like highest ever withdrawals on these funds, private credit funds, private equity funds. Main Street Capital struggled as well. So anyway, though, this one's my favorite. They pay monthly. They have an 8.2% dividend, just as good. And this one actually pays you by the month. And sometimes they make so much money, they do special dividends. They're kind of like REITs. I actually own a few REITs, real estate investment trust, and those are ideal to own in your Roth IRA because technically what they pay you are distributions and not dividends. So whenever you receive those dividends, in quotes, they're actually taxed at short-term capital gains. All the dividends I receive from all these companies, like your average company, like McDonald's, Google, Altria Group, those pay qualified dividends, which are taxed at long-term capital gains. But Main Street Capital and REITs pay dividends at short-term capital gains. So you are taxed at your income level on those dividends. All right, so let's see. Eric says, hey, what's up, long Bitcoin? Yeah, dude, Bitcoin has been struggling. I'm basically buying the Bitcoin proxies, like a SoFi, a Robinhood, a Futu. These stocks usually move with Bitcoin, and Robinhood, SoFi are down so much because Bitcoin is down so much. And I'm basically buying Bitcoin by buying Robinhood. So can you do Lyft and CoreWeave? Yeah, let's do Lyft stock right here. I actually own Uber, so I kind of prefer Uber over Lyft because Lyft is a pure rideshare business. They do pure ride sharing. When Uber, they do, Uber Eats and business-to-business delivery and freight. So here's Lyft right here, though. They do ride sharing. How are they doing? So they are still not making money yet. They're like just now getting net income positive. So when we do a forward PE, it's going to look extremely expensive. Well, actually, no. Well, hold on. They're at a 17 forward PE, so they only trade at 17 times next year's net income. Let's check out the forecast. Well, yeah. So next quarter, they're supposed to make 56 mil and then 83 million of net income the quarter after that. Huh. That's interesting there. So here's the revenue growth over time. Yeah, revenue growth looks good. Little hiccup in 2020, but then it had a nice little recovery after. So yeah, anyway, 13% revenue growth. I still like Uber more than this one, but I like that 17 forward PE. I mean, real talk, 17 forward PE is cheap. So Morningstar says they're reasonably valued. While execution on cost discipline and third-party partnerships support near-term profitability growth, the company's lack of self-reinforcing network effects and a smaller scale relative to Uber constrain long-term value creation. So that's one thing you maybe want to be cautious with. And here's my Uber position. I'm just barely up on them. I'm up, they're one of my most recent purchases. I'm only up 0.27% on Uber. All time in this portfolio, we're up 26%. I love being fully transparent. I go to a bunch of other streams and stuff. No one like shares their whole portfolio and what they own and how much they're up and down lifetime. MicroStrategy is the best to follow Bitcoin. Yeah, MSTR, this is like leveraged Bitcoin. So yeah, whenever Bitcoin goes up, MicroStrategy goes up more, like here. Blue line is actual Bitcoin, but whenever Bitcoin falls, they fall more. So look at them, Bitcoin, a month ago they were at the same price. Bitcoin has fallen this much, but MicroStrategy's fallen more. So Strategy acquires 1,515 Bitcoin for 100 million at 65,000 per coin. This is their first purchase below their average cost basis since 2020. Whoa. Strategy faces 10% bankruptcy probability in 2026 as Bitcoin holdings show 11.7 unrealized loss. And they also sold 32 Bitcoin to fund their preferred stock dividends. If anyone's ever heard of STRC, in my opinion, don't buy this. This is supposed to always stay at $100. It's like it's supposed to stay at $100. It's literally decoupling from $100 because people don't trust this anymore. So they like in Strategy to sell Bitcoin to fund dividends on that. I don't know. 10% bankruptcy probability. I don't know if I would try. I'd be real careful with that. How about Micron? Yeah, hey, this is your memory shortage company. So if you've heard of the RAM shortage, SSD hard drive, Micron is one of the main beneficiaries of that. So NVIDIA certifies Micron as memory supplier for next generation Vera Rubin, NVIDIA chip. Wow. Micron selects Bechtel as construction partner for $20 billion New York semiconductor facility. NVIDIA CEO forecast multi-year memory chip shortage. Wow. So yeah, Micron is your chip shortage play, and here's why it's tough to be bearish. I know they've had such an insane stock price appreciation the past 2 years, like a 10, 20x, but here's the thing. Here's why we're probably not in a peak valuation bubble. When we look at them and value them off next year's EPS or next year's net income, it's a 10 forward PE. Trading at 10 times next year's net income. Here are the actual net income forecast. They're supposed to make 22 billion next quarter, 26 billion the quarter after that. They're basically going to be making just over 100 billion of annual or of net income for that next year, and they're worth 1.1 trillion. So yeah, that's how they only trade at 10 times next year's net income because they're making 100 bill and they're worth 1.1 trillion. But the thing is, here's what analysts are forecasting. 2026, 2027 is peak ever EPS because again, they just sell a commodity. They just legit sell basically consider it like a flash drives, but super huge ones. They sell, RAM. This is a low margin commodity, but there's a huge shortage right now because data centers are taking up all the supply that they get cooked. Oh yeah, Micron, we have the perpetual stock price right here. They're at $1,007 a share right now. And on Friday, they closed at $981. So they're up 1.3% right now. All right. How high can SOXL go? What is that one again? Oh, the daily semiconductor 3x bull ETF. I would be very careful with the 3x ETFs. Because these are meant to swing and day trade. You want to get out of these as soon as possible. There's already so much volatility in just buying, Broadcom, Nvidia. I'd rather just, own those. So RGTI, please. Yeah, hey, Quiddo, that one I don't have anything too good to say about this one, sadly. I'll be really quick about this one, but here's the way I judge a stock. The whole company is worth $6.97 billion. So you could buy the whole company for $7 billion. That's the valuation you're buying in it right now, $7 billion. I can't value this company anywhere close to $7 billion. The revenue was $4 million this quarter, $1 million last quarter, $1 million the previous quarter, $1.8 million. So they're doing a couple million in revenue a quarter, and they're losing $25 million in net income, and the losses are worsening. So I just personally can't get to $7 billion, but what this stock could be cool for is a short-term swing momentum trade because quantum seems to be what investors love right now, but I just can't get anywhere close to 7 billion. And I know a lot of companies worth 7 billion dollars or look at Dave, you know what? This company is worth half that. Here's a company that's worth half of what they're worth. This company's worth $3.6 billion dollars. And this company right here, they're not doing 4 mil of revenue a quarter. They're doing 158 mil of revenue a quarter, and they made 57 mil in net income on that. They're the most profitable they've ever been. That's after tax. And they are running at 30, 40% net margins. So, I'd rather own some of these smaller caps with way better fundamentals. That's the way I look at stocks. Okay. Oh, I'm a little behind here. Sorry. VRTX. Let's do VRTX. And I don't know that stock. If you have a stock you want me to look at, like I see Health or Hinge Health, give me the ticker symbol for a stock. Oh, SpaceX. Hey, we literally just looked at SpaceX like 5 minutes ago. Lamb. Feel free to rewind though. Maybe we'll check it out toward the end of the stream again. Recently, I sold puts on Blue Owl at 125. Oh, hey, nice. Is that worth doing? I know they have a high yield, so I don't know what the premiums on that are. So here's Vertex Pharmaceutical. They've actually done phenomenal. So congrats if you own this stock. They are flat on the 1 year though. So Morningstar says they're overvalued slightly. Its domestic, while its dominant cystic fibrosis franchise continues to generate strong cash flow, a high dependence on the single market and potential U.S. pricing pressure require caution. So anyway, interesting. So here's what their main prescription, which is 78% of all the revenue, did actually fall 7% year over year. So that actually might be why the stock, gapped down on this day right here. That was on earnings day. That might explain why the stock is flat from 1 year ago because their main core business did fall. Their second biggest business, Alftech, whatever. Wow. Look at that year over year. It went from 53 mil of sales in Q1 last year to 424 mil. Now that's something to watch. That could be a huge growth driver in the future. So anywho, when we do a forward PE on this company, what do they trade at? So a 24 forward PE, so 24 times net income seems pretty fair. So every quarter they seem to make it easy over $1 billion of after-tax net income every quarter. So there's some cool cystic fibrosis company right there. So, Grab stock? Okay. Grab, this is an international Uber. So Grab does literally exactly what Uber does, ride sharing, food delivery. But look at, this is a universally needed commodity. Even in other countries, people need help, could use a ride share. Look at where this company's revenues come from. Notice the US and Canada and UK isn't on here. It's Malaysia, then Singapore, then Indonesia, then it's Philippines, Thailand. This is Uber, but internationally, and this is how Uber is so genius. Uber is now the largest shareholder of this company. So they're basically backed by Uber, and this was Uber's way of getting international exposure because they're having a tough time getting into some of these markets, but Grab literally owns Uber is the largest shareholder of Grab now. And you're basically buying them as they're getting net income positive for the first time ever. So if we zoom out, Grab was a tough buy. A year, 2 years ago, they were losing like 100 mil a quarter sometimes. Well, now they're making consistent net income every quarter. So big fan of Grab. But they might be still slightly expensive at their forward PE, but I still do really like them. I hope TikTok don't start making Hey, what's up, Brian? Yeah. So what's your thoughts on Super Microcomputer? Yeah, what's up, Goofy? So Super Micro, this is the company that installs chips. So a company goes and buys NVIDIA chips like for their data center, and Super Micro is the company that puts them in a rack and installs them in your data center for you. So right now, though, they just had a massive downtrend because they diluted shareholders by a bunch. They raised $7 billion by issuing shares. Here's the thing. The whole company, well, at the time they were worth 25 billion. When you issue 7 billion of your stock, that dilutes every shareholder by 15%. So every shareholder now owns 15% less of the company than they did a year ago. But look at this forward PE. I mean, I don't know if this forward PE estimates include the dilution that just happened, but they trade it at 10.4 times next year's net income. So that's where Supermicro starts to look really cheap. But there's also been a lot of trouble around this one. Like they were smuggling chips into China. Literally, that's why they fell this day. They smuggled chips into China to prop up profits. And the CEO quit that day because of that. But it looks like the net income is starting to grow again. Last year it was 108 mil in net income. Now it's 483 mil in net income. So it does look like the net income is finally starting to recover. Next quarter, analysts expect 419 and 376 million. So very interesting. So yeah, it's kind of tough to be bearish at a forward PE of that. So, oh yeah, Marvell. Let's do Marvell. Or actually, let's do Bloom Energy because we already done Marvel earlier. Then we'll do MRVL after this and look at a few more. So, here's Bloom Energy. This is an alternative energy business right here. Bloom Energy identified as potential candidate for S&P 500 index. Wow. Crusoe Energy pauses 1.8 gigawatt Wyoming data center involving 900 megawatt of Bloom Energy fuel cells. Huh. I wonder what happened right there. So let's go look at what the company actually does. So they make, it's like this alternative energy storage. So they install these solid oxide fuel cell based power generation platforms. So basically, power generation is popular now because data centers are having a hard time connecting to the grid. You know, it takes a long time to connect to the electricity grid. So they're just bringing their on-site poweration, like on-site power generation to the data center. So they don't need to go to the grid. That's also what Constellation Energy is kind of doing right now, bypassing the grid by just placing data centers right next to their nuclear reactors. But yeah, anyway, here's their website right here. They use here's their 1,200 plus installations. They used to have like a selling point. I guess here's their like a picture of them. But anyway, pretty cool energy company here. But the tough part is if we go to a forward multiple here, like who's going to buy this? You know, 160 forward PE. It's definitely not one you'd want to buy today, but the net income forecasts are very good. They're supposed to make 81 mil next quarter, 119 million the quarter after. The net income, I don't think has ever been close to 119 million before. Yeah, they used to consistently lose money. Now it looks like they're finally going to consistently be making net income from now on. So yeah, I can see why the stock has done so well. Literally 4 quarters ago, so 1 year ago, it was a $16 stock. Now it's 260. So you definitely want to be careful buying after such a hard, huge rally. Okay, so I saw some people say IONQ. Do you believe in quantum? I do believe in quantum. IONQ is an interesting one. I kind of call this one like quantum version of MicroStrategy. So what they do is MicroStrategy, they issue shares and buy Bitcoin. What IONQ does is they issue shares and buy quantum companies. Martin Shkreli accuses IONQ of making false claims about quantum technology's Bitcoin mining capabilities. Alleging the company told multiple people their quantum technology could mine all the remaining Bitcoin in 48 hours. Okay, yeah, that is a stupid claim. Mine all Bitcoin in 48 hours. Accused IONQ a strong short candidate. Okay. Anyway, let's go look at their financials. So they've done like 6 acquisitions in the past year, and that's what's fueled basically a lot of this revenue growth. Because a year ago, the revenue was very little, a couple million a quarter. Now it's 64 million, up 754% year over year. But the bad part is they're still a big money loser. If we go to, net income right here, the real losses, they lost the most they ever have. 270 million, 230 mil, 170, 160. So they are losing the most amount they've ever lost. So they're so far away from profitability, but they do have nice top line growth. But that's what makes this one a tough buy, in my opinion. It's just hard to trust a meaningful amount of money in a company that's so far away from profitability. Morningstar says they're overvalued. Although the company exhibits rapid revenue expansion in its quantum computing services, extreme operating cash flow deficits, and a severe lack of sustained profitability are a major risk that requires investor caution. Yeah, they're right. Look at FCF, which is free cash flow, losing 100 mil free cash flow quarter, and the net income is just as bad. I'd be real careful with that one because of that, but it's still interesting though. But Amazon used to own that one. Amazon did actually sell out of that one. You are very well informed. Oh, hey, thanks, Goofy. I appreciate that. I really enjoyed the show. Thank you for doing this. Can you look at Iris Energy? Yeah, sadly, I have to go in 20 minutes exactly. So, yeah, let's analyze a couple more stocks here. And for sure, I stream every Sunday at this exact same time. If you'd like to hit the follow button, I sell literally nothing. I promise. I have no course book. I'll never follow you, DM you. I sell nothing. Only way to support me is to hit the like button and subscribe if you'd like. So, Iris Energy. Oh, and we'll look at Nokia. I actually really like Nokia. So, Nokia, That one is owned by NVIDIA now. So NVIDIA also owns Iris Energy. NVIDIA took a stake into Iris Energy. I would be more careful with Iris Energy though, because yeah, NVIDIA's Iris Energy partnership. Um, the tough part is that all this company, this isn't the part of AI I want to own. All this company does is rent out GPUs. So basically, they own a boatload of GPUs and they rent them out. Still, with their GPUs, 76% of the revenue as of 2026 Q3, 76% of the revenue is Bitcoin mining. So they're using these GPUs to mine Bitcoin, but they're about to convert it from instead of mining Bitcoin, they're renting out the GPUs to cloud companies who need it. So the tough part is, though, the net income forecast. They lost 250 mil this quarter, 155 mil last quarter. They're supposed to lose 117 mil the quarter after, 130 mil the quarter after that. So, I personally like companies that make net income and look at the free cash flow, very negative free cash flow. And it's tough. I want to own companies that make free cash flow and make net income. That way they can return it to me as a shareholder via dividends, share buybacks. And I think they're headquartered in Australia because look at that. 76% of all their revenue is from Australia. Yeah, they're headquartered in Sydney, Australia, New South Wales. So it might be like a US ADR. So you have to pay ADR fee maybe. But anyway, Morningstar's not too bullish as well, sadly. Highly uncertain long-term demand for AI cloud infrastructure, a subpar user experience compared to peers, and significant capital that could dilute shareholders require caution. So that's why I would be careful with Iris Energy, but I bet they'll still probably do good maybe through the end of the decade if NVIDIA does. But the money losing part of the business is what scares me. So let's check out Nokia stock. Yeah, that's a big NVIDIA holding. If we go to the NVIDIA portfolio right here, the largest holding is Intel, then CoreWeave, then Coherent, and then it's Nokia stock right here. And I bet that NVIDIA investment has led to a lot of this momentum because the stock's been on fire. A year ago, it was $4. Now it's $14 a share. So Nokia has converted. It used to be a smartphone company. In the year 2000, the stock was $55 a share. Now it's $14 a share. They lost the smartphone war to Apple. Now they are really a cloud in AI and data cloud company. That's been the most recent growth driver of their stock. Check out the second line in the middle. It says AI and cloud related business sales increased 49%, generating approximately 1 billion euros in new orders, significantly boosting profitability. So that's why I think the stock has done so well on earnings and the momentum has sustained because, their AI and cloud business is growing very fast, 49%. They're trading at a 44 forward PE, which does make this a tough buy. So they have had a lot of. So basically, now's not the time to buy Nokia significantly because they have had a pretty insane rally. And at 44 times next year's net income, the risk to reward is a bit risky. So I would wait for a lower price. But I mean, that data and cloud, AI and cloud business growing 49%, very impressive. Where should the forward PE be at looking at each stock? It all depends. It all depends on the stock in the sector. Like if it's an oil stock or if it's a software stock or, like an Adobe's at a 10 forward PE. Even Adobe, most people when looking at forward PEs, they're like, hey, Adobe trading at 10 times forward PE or 10 times next year's net income, that's cheap. But sometimes it's, cheap for a reason. It's relative to each stock. Each stock is its own story is what I'm trying to say. Hey, we literally just looked at Grab like 5-10 minutes ago. You know what? Should we look at it one more time? I'll be quick with my thesis, but if you want I'll be quicker with this one. If you want my real in-depth analysis, this literally is like 10 or 15 minutes ago on the stream. Thanks for showing up. Grab is international Uber. They do exactly what Uber does, but check out where the countries come from. Notice US and Canada aren't on here. They do ride sharing and food delivery in Malaysia, Singapore, Indonesia, Philippines. This is a universally needed commodity. Even people in these other countries need help with a ride share or want their food delivered to them because they don't want to leave their house. So anyway, what's cool is Uber is having a tough time getting into these markets. So Uber decided to buy this company. So Grab is basically backed by Uber. Uber is the largest shareholder. Uber wants to see them succeed. They are a 13% shareholder. Toyota Motor owns 5.5% of all the shares. And the cool part is they're the most profitable they've ever been. A couple years ago, you couldn't buy the stock because they were losing a bunch of money, but now they're making a lot of money every quarter. They're basically just just now getting net income positive for the first time ever. So that's why when we do a forward PE, they still look expensive at a 29 forward PE, but that's because they're just now getting net income positive for the first time ever. But the risk reward is starting to look very good. And I technically own this stock via Uber. In all honesty, just buy Uber stock as well. It's like a safer play. But yeah, I'm just barely up on Uber, 0.27%. Yeah, international Uber is what I like to call Grab. All right, hey, I was asking for the ticker symbol earlier, but you know what? I'll find it. Oh, it's HNGE. You know what? We found it, Yuck. I got you. I was asking for the ticker symbol. Yeah, if you have any stocks you want me to look at, please give me the ticker symbol and not the name. Especially if it's a stock I've never heard of before. What's your thesis on Uber Meta? Hey, we've already analyzed both of those, but we'll come back to those because I got 10 minutes left and I got to go. So here's Hinge Health right here. They've done quite well. If we zoom out, this is an all-time high. So if you've ever bought the stock, you're definitely up on your money. All the revenue comes from the US. Yeah, no, they're at all-time highs for a reason, and they gapped up on earnings day back here because the earnings was a good beat. So the orange line is what analysts predict them to report. Analysts projected 12.69 million. They reported 35 million. And they beat on revenue. They expected 172. They did 182. So this was record revenue this quarter, 182 mil of revenue. That was a record. It's not done. There's still a lot of future growth. In 2 quarters, revenue is supposed to hit 209 mil. Net income is supposed to hit 36 million. And that's assuming they don't beat on earnings, because historically they beat on earnings every quarter. The free cash flow is super positive. The revenue's at a new record. Dude, thanks for telling me about this stock. I'm actually going to put them on my watch list. Maybe we can go to their website right here. Health Information Services, pain relief for everybody. Oh, I get that, for everybody. Made for, I don't know what they do. Is it like a 2.4x ROI proven across clients? Transformation, workforce health while lowering costs. So maybe this is for businesses. It's like a B2B play. Request a business demo, trusted care. So here's their selling point. Average reduced and reported pain, 68%. 58% reduction in reported depression and anxiety after 12 weeks. 67% average reduction in surgery intent. I don't know what this is exactly, but if these are like true selling points, I can see why they're doing so well. Thanks for that one. That's on my watch list now. All right. Can you check QBT? Yo, why isn't Mara moving like before? So Marathon, this one I'd be careful with. It's like a Bitcoin mining company, and it's always underperformed Bitcoin. Yeah, the tough part about Marathon is why aren't they moving like they were before? Look at revenue now. Revenue is negative. The organic revenue, the lifeblood of the company, the sales are down 18%, and they lost 1.26 bill. Or actually, they only lost 250 mil, but that's still 58%. They worsened their losses by 50%. So that's the tough part about Marathon. They're a big money loser. Maybe even bankruptcy risk. So Fazo said SOBR. Let's do SOBR. So sober safe. We're actually not going to cover this stock right here. We just don't cover these. Who's going to buy this? If you look at the top right, the market cap, they're worth 2.88 million. So you could literally, if you had $1 million, you could buy pretty much half the company. You could buy a third of the company for $1 million. This is such a tiny micro cap. Don't even touch this one. So they're definitely going bankrupt. Look at this. So let's say you buy the company for $3 million. You pay $3 million. Well, you just bought something that lost 2.29 in 3 months, and then 2.89, and then 2 million. So you've already lost your whole investment in less than 6 months. And whenever you lose net income, that money has to come from somewhere. So look at their balance sheet. I mean, the assets just continue to decline because they lose net income. Anyway, there's real bankruptcy risk there. That's going to zero. Please don't buy that one. Sadly. Oliver said GE Veranova. I've actually not covered GE Veranova yet. So here's a cool story. Under every data center are 2 backup generators. So if the grid goes offline, data centers can't afford to go offline because that costs them millions of dollars a minute. So they have 2 backup generators under every data center being constructed, and that's why GE Veranova is benefiting right now. Here's what Morningstar's saying. They're reasonably valued. Its leading position in gas turbine markets and strong tailwinds from the multi-generational electrical supercycle will drive long-term value growth. I'm a big fan of the electrical stocks doing the complex MEP work for data centers. So GE Veranova is one of them. And this was a spinoff from GE Aerospace or GE. They're very net income positive, and they have, this is the craziest part, like a $500 billion backlog of orders. There's no news right there. But anyway, they really do have like a $500 billion backlog of orders. Morningstar says fair value is $1,000 a share. But at a 50 forward PE, the risk to reward does look tough. So they trade at 50 times next year's net income. So electrification segment revenue increased 61%. Wow. I love the electrification companies, doing that for data centers. So let's check out SLB. Is that Schlumberger? No, that's not. So this is an $83 billion oil and gas company. So these commodity oil, let me make sure it's an oil and gas stock. I'm assuming it is. Yeah. So oil and gas stocks historically don't outperform the S&P 500. Technically, this stock is literally the same price that it was in 2005. So you bought the stock in 2005. It's at 56 a share. It's 56 a share still to this day. But they've had a nice little rally these past couple weeks and months. I'm assuming because of the actual price of oil with the war fears, the Strait of Hormuz. They're at a 20 forward PE, but that's normal for these oil and gas stocks. Well construction, reservoir performance. How's well construction? That's down 6%. Reservoir performance is down 6%. But I'm assuming this is going to grow in the future, especially with oil prices going up. But anyway, you're not buying that to outperform the market. You're kind of buying that as a defensive hedge in case, oil goes up again and there's commodity. Hey, well, we'll look at LUNR and AIIO. Yes, sir. We'll check these two out. So here's Intuitive Machines. This one back in the day, I remember way back here, I was watching this stock. They sent this, I don't even know what to call it, like this rover to the moon to collect data, but then it tipped over and broke and collected no data. So the stock plummeted that day and it fell to $6. But now they've got some more NASA contracts and now it looks like their momentum is back up. I still would not own this company. SpaceX IPO triggers broad space sector sell-off. Yeah. So anyway, and actually Intuitive files $500 million dilution program. So they're diluting all shareholders by over 10%. So you now own 10% less of the company than you did a year ago. And it's because they needed to raise cash. They don't make money. The only time they ever made money was 2022 Q4. They made 13 million. And then ever since then, they've just lost like 15 million in net income every quarter. And the losses have worsened. They lost 40 million this quarter. So that's the tough part. They lose a lot of money, but whoa, look at the revenue boost this quarter. That's actually ridiculous. 186 mil of revenue. Oh, so that's not organic. They acquired a company. So they actually invested in cash from investing activities, $500 million. You want this to be negative. That means they're spending their cash buying an asset. Or, this could be anything, buying NVIDIA chips or buying a data center or buying a new truck or something. But it's good to see. I'm pretty sure they just did a huge acquisition. And that's what kind of artificially made their revenue go up. I wonder who they acquired. Anyway, still would be very careful with that company because they're still very far away from profitability. But they are interesting. Izzy said VOO. So this is a great way to just, sleep well at night. Everyone tries to outperform the S&P 500. The literal average retail investor, hedge fund, and institution cannot outperform the S&P's 10% CAGR. So if you can't beat it, I promise you, at least own it as a little bit of your portfolio. Because not if, but when it outperforms you, you won't feel as bad. So literally, you can't go wrong buying the S&P. It just gives you 8 to 10% of your money back a year. One of the best ways to beat inflation. That one's run by Vanguard and has a very low expense ratio fee. That's why I like that one. So AIIO, so this is Robo AI. These are companies I kind of just be really careful with because if we look at the market cap, this whole company is only worth $53 million. That's just such a small market cap. $53 million company. Let's see. So the United Emirates, so they're actually headquartered in the UAE in Dubai. They have 29 employees at Robo AI. And are they a revenue list startup? Yeah. So basically for full year 2025, or actually, well, this is her fiscal, or no, that's full year. Full year 2025, they did 950,000 of revenue and lost 167 million. So it's just tough to trust a $53 million company that did 950,000 in revenue for a whole year and lost 167 million on that. Look at this. No wonder this stock's at an all-time low. They have 8 million of assets and 124 million of liabilities. Textbook example of a stock you don't want to own. This is why I always look at fundamentals. There's a ton of stocks on a dip. I can recommend other stocks on a dip on a massive downtrend. You don't want to buy the one on a massive downtrend that genuinely has just dog financials where they're definitely going bankrupt. You know what I mean? LAES. So yeah, hey, um, what is LA? Yeah, this is another quantum company. Yeah, can't. They're worth $690 million. So worth 690 million, lost 34 million, and they only did 18 mil of revenue for the full year 2025. They only did 18 mil of revenue, lost 35 mil on that. I guess I don't know. This one I'd be super careful with. There's supposedly another quantum company, but I don't know about that one. So yeah, ServiceNow. We'll look at ServiceNow and Amazon, and then I gotta go. Actually, I don't even have time for that. Hey, we just looked, Fazal, we already looked at SOBR. Don't buy that one. Okay, so wait, what stock did someone say? Hey, what's up, AJ? So yeah, we've actually already looked at ServiceNow like 4 times. Basically, you want to be careful with this one because of the high PE. But what's interesting is they're giving this 2030 projection of 30 billion in revenue. So in the year 2030, they're going to do 30 billion in revenue for that year. If we look at the full year 2025, they did 13 bill of revenue. So the revenue is going to more than double. But what's cool about ServiceNow is that you don't see many companies like this where literally by the quarter, the revenue hits a record. Like literally every quarter it hits a new record. And they're not just growing revenue, but they're super net income positive, making 400 to 500 million of after-tax net income a quarter. But the bad part is they trade at a 47 forward PE or 47 times next year's net income. That makes it a tough buy because if we get another real software sell-off, I could see this forward PE falling to like a 40 or a 38, 39, and that could send this down another 20%. So now is not the time to go all in on ServiceNow. It may be a decent nibble, like a very small position, but now is definitely not the time to go all in. So anyway, that was the stream. I hope you guys have a great rest of your Sunday. If you want to hit the follow like button, that'd mean the world. I stream every Sunday at this exact same time, and I literally sell nothing. I have no course book, WhatsApp, literally nothing at all. The only way to support me is to, hit the follow and like button. So I'll end this with actually, I have to go right now at 2. So anyway, have a great rest of your Sunday. Thanks again to everyone that showed up. Best way to support me, again, go over to the YouTube stream. If you're on TikTok, please go to my YouTube channel. It's called Nathan Robert. Just type into YouTube Nathan Robert. You can rewind the stream. TikTok, remove my stream for body exposure and sexualized behaviors. So I'm taking off TikTok for apparently that. Don't know how that's even possible, but I always stream on YouTube. It's called Nathan Robert. Please show up over there. If you leave a comment on my YouTube video, I'll leave you a nice reply. Thanks again. See you soon. Hey, thanks again, Fred, Rolando, AJ, Marcus, Zero. Oh, and if you're on the YouTube stream, I have a private Discord. It literally costs $1 to join. It's kind of just for fun. If you have any personal questions for me or want a personal analysis on a stock, I have a private Discord. It costs $1 to join in the description. Or if you become a YouTube member and pay and cancel the YouTube membership after, you get permanent access to my private Discord, even if you cancel your YouTube membership after the first month. Or you can just pay a one-time $1 fee. And I made it the literal lowest amount of money possible to prevent bots and keep scammers out. So $1 or you can